हाय इन्वेस्टर्स, वेलकम टू SOIC। तो आज की इस वीडियो में वील बी मीटिंग वन ऑफ द इंडियाज स्मार्ट इन्वेस्टर्स हु इन्वेस्ट एक्सक्लूसिवली इन माइक्रो कैप टू स्मॉल कैप स्पेस। तो आइडिया क्या है SOIC चैनल का, क्योंकि वी कीप इनवाइटिंग सच स्मार्ट एंड ब्रिलियंट इन्वेस्टर्स जो एक्चुअली में प्रैक्टिशनर्स हैं। प्रैक्टिशनर्स कौन होते हैं? जिन्होंने खुद की जर्नी में एक्चुअली में वेल्थ क्रिएट करी है, अपना एक फ्रेमवर्क बनाया है एंड वो अपना फ्रेमवर्क आप सबके साथ सेल्फलेसली शेयर कर रहे हैं। So the name of the investor is Mr. Debashish Neogi, and he's been an investor in the micro cap and small cap space for multiple years. He has also worked at Marico, and he's been in the corporate world for multiple years now. एंड अभी वो फुल टाइम इन्वेस्टिंग कर रहे हैं एंड साथ साथ उनके फ्रेमवर्क से जो भी ये रिटेल इन्वेस्टर्स ये वीडियो देख रहे हैं, तो आई विल हाईली सजेस्ट कि आप एक नोटबुक एंड पेन ज़रूर लेके बैठे इस वीडियो में, क्योंकि उनके फ्रेमवर्क से यू विल लर्न अ लॉट ऑफ न्यू थिंग्स। इफ़ यू आर एक्साइटेड फॉर द वीडियो, जस्ट ड्रॉप अ हेल येस इन द कमेंट सेक्शन, एंड इफ़ यू आर न्यू टू द चैनल, डू टेक द प्रॉपर लर्निंग्स फ्रॉम द वीडियो, बिकॉज आज के टाइम पे एक बुल मार्केट चल रही है एंड बुल मार्केट्स आर गुड ओनली, बट आइडिया इज़ कि अगर आपके पास फ्रेमवर्क नहीं है तो यू वॉन्ट बी एबल टू टेक एडवांटेज ऑफ बुल मार्केट्स. So this is the idea that you should invest a lot in your key learnings right now. And इसके साथ साथ we keep doing these weekly meetups, हम webinars करते हैं जहाँ पे हम different sectors, different accounting parameters and जो different investors हैं उनको invite करते हैं, जो जितने भी SOIC students हैं उनके लिए. If you also want to become a part of SOIC membership, the link is there in the description below. So with this, let's start the video. Hi and welcome to each and every one of you to the SOIC Tribe Meet, in which we'll be interacting with most interesting small and micro cap investors in India. So the name of the investor is Mr. Debashish Neogi. He's been into the investing landscape since last 20 to 25 years almost, I think, or more than that. And he's been working in the industry, so he has a work experience of more than 27 years across 5 corporate groups. And he's directly worked under Mr. Harsh Mariwala. And apart from that, he's one of the largest small and mid cap, micro cap investors in India. And so you also run your FMCG business in Dubai, which is of it's a chocolate brand, right?
Correct.
Very interesting. And so he also has an algo option trading platform. So this is the beauty of investing, that you keep learning and you keep evolving. And so over to you, sir, and we can start the session. So just before I start, a standard disclaimer: nothing in the session will be a buy or sell recommendation. It's purely an educational session, so that all of us learn from his experience, and it will give us a lot of exposure at how 2 or 3 decades in markets they end up basically looking like. So flow of the session will be: first I've done the introduction, now sir will do a presentation, and once the presentation is done, we'll have a round of question and answers. Over to you, Debashish, sir. And just
thank you.
Everyone just write welcome Debashish in the comments. So I think most of the tribe members have joined. I think we have a participation of almost 600 students close to. Right.
Wow. Okay. Thank you, Ishmoit, for your nice words and introduction. First of all, thank you for inviting me. Okay. And sorry I could not make it earlier. And I'm amazed by what you are doing. Okay, the kind of materials you have on your website and the way you teach, it's amazing. It comes naturally to you, and I'm amazed by the width and depth of the content which you cover. So I wish when I started my investment career 25 years back, I wish, I had something like SOIC. So I'll quickly, and good afternoon in India. Good afternoon to every one of you. First of all, Ishmoit gave a brief background of me. So I'll just add to it a little bit. Okay, so people normally do one role, and if they're lucky, one innings maybe, in life. If they're lucky, they play two innings. I have been extremely lucky, by grace of God. I'm doing my third innings. Okay, so I start my career as a CFO. I'm a chartered accountant, cost accountant. I started as a CFO, then moved as a CEO. I became a turnaround specialist, and then I'm on my own for the last more than 5 years, where what I have learned from Marico and more so from Harsh. It has been amazing experience. No MBA school will give you that. And I'm just applying those principles in my own business and the investments which I do. So some of it I will talk today. And I've been investing for 20-25 years, along with my job. And last more than a little over 5 years, I'm full-time investor. So so that is the third innings I'm playing, and it's a dream innings. So I'll share my learnings. Okay. Only thing is that I'm not able to see all. So I would prefer, a offline kind of meeting, but now we are used to this online meeting. So I will not be able to see, y'all and have eye contact, but that's okay. So I'll bear with it. It's little disadvantage for me because it almost becomes a monologue. Okay. So I will keep on talking maybe for 1.5 hours, and then, as Ishmael said, we will take the questions. First of all, I started investing around 99. Okay, so it's just 24 years back, and I made all type of mistakes. Okay, so I can actually have a presentation on mistakes itself. Okay, so library of mistakes, you can say. So whatever a person can uh, do a particular type of mistake, I have done everything. Okay, so the advantage which I have is that the mistakes I have done is in initial part of the career, and because of which the cost of the mistake was comparatively lesser if I had done the same mistakes now. Okay, that was first. So mistake number one, in 99 I started investing on tips. Okay, so I don't know, some of you would know that in 98, 99 there was a tech boom which happened globally and in India. So I used to buy on tips. So I knew a few people, brokers, and there were discussions on breaks in the office where I used to work, and we used to buy on tips. Okay, that's mistake number one. Some of them made money, and when it makes money, you feel that you have the skill, right? Okay, so it gets to your head, that initial quick success, quick money. So you earn some salary, but you are making more money, through investments without doing anything, right? So it gets to your head. So what you do then, then you become greedy. So I also became greedy. So if my CTC was 100, I'm just giving 100 as a benchmark. So I was leveraged 3 times. So I took loan from 3 banks, personal loan. That point of time, it was 18-19% per annum. So imagine, I took a loan of 300 compared to 100 annual salary, right? And I was buying the tech stocks. I was buying, then I thought, all the stocks which were having were high PE. So let me buy statistically cheap stocks. Okay, I was trading also. When I say trading, I'm talking, buying today morning and selling tomorrow. Okay, sometimes the same day, the market is, that stock is up 8%. So it was beautiful, until the dot-com burst happened. Okay, early 2000. So my portfolio, which was leveraged and over 300, in the next 2 years, okay, it was down less than 30. So which means, my investment and the profit, okay, all were wiped out. It was a drawdown of more than 90% in 2 years' time. And subsequent to that, I didn't recover because all were junk stocks and they became junk. Okay, I didn't have Infosys that I had to, after 20 years it recovered. I didn't have, Infosys of the world also, at least where my capital would have got protected after, few years. But so this was the scenario. So in this kind of scenario, okay, that is the time I got married and I had my first child. Okay, my father had retired in around that time. My father-in-law had retired. Okay, my brother moved from Delhi and he was looking for a job. Okay, I started a family, have a wife, one kid. We were staying together, a joint family. So you can understand, the not only me but my family and extended family were dependent on me, and I was in a stage where I almost went bankrupt. Okay, so everything went wrong for me. Okay, so why I'm sharing this, because it's very important, to get a personal perspective. Okay, where I started. Okay, and how I started. Okay, so then, I put in my papers and searched for, better and better job at that point was decided for me was any job which could pay more salary than what I was getting. Okay, so I got a good break. Then I was called to Marico head office. The CFO then, Milind Savate and Harsh spoke to me, and they retained me and gave a posting in Bangladesh, where my salary was much higher than what I was getting in Calcutta. Okay, and we were starting operation in Bangladesh, so I was the second employee there. Okay, and after that, there was no looking back. So let's not get into the professional, part where whatever a professional can do. Okay, I did in that Bangladesh stint, including getting the company listed. Okay, in a span of 8 years' time, and I was bankrupt, almost bankrupt, the way I said, early 2000, 2001, and then Bangladesh stint started in 2002. And when you are in overseas locations, your salary is higher, expenses are taken care of by the company, so you are making savings, so that I kept on deploying in the market. Now what changed is, now I don't invest on tips. I am far away from the market, not connected to people who give tips. Okay, because in Bangladesh, there were no people apart from me who was investing in Indian market. So I started reading. Okay, and that is the first time I got to know about a person called Warren Buffett. Got hold of his letters, and I read everything. Then I said, oh my God, what I was doing and what this person. So the person became a god to me, a mentor who I never met. Okay, a guide who I never met. Okay, so I started reading, and since then, okay, I have become a better investor. Okay, it's not that I don't do mistake. I still do mistake, but these mistakes are always new and never the ones which I made. So one point I wanted to tell is that after this episode happened, where I leveraged, okay, and had a drawdown of more than 90%, that learning, okay, I never repeated again. So in spite of today, where I can leverage my portfolio, where I can take loan at cheap rate, in being in Dubai, which is LIBOR plus, okay, I have never leveraged myself, never. Okay, so as I said, I never repeated the same mistake. I make new mistakes, and now I feel I'm a better investor, but still learning from people like Ishmoed and many others, and many other websites, which I will talk during the course of the presentation. Now today my presentation is, as I said, how to find multibagger. Okay, now What is a multi-bagger? Okay. Multi-bagger in the context of finance and investing, multi-bagger refers to a stock or investment that generates exceptionally high returns over time. A multi-bagger is typically used to describe an investment that has appreciated significantly, often several times its original investment value. Okay. Now here, there are two words which is very important. Okay. That investments generates exceptionally high return and over time. Okay. Now, exceptionally high return is a relative word. Over time is also a relative word. Okay. So typically when people talk about multi-bagger, they talk about you invest $10 in a stocks, which actually become $100. Okay. So it is considered to be a multi-bagger if it grows 10 times, right? So that is called a multi-bagger for our purpose of the presentation. Now I'm going to share with you, okay, my actual experiences and how I've got them and what process I follow. One thing is very important to know. Here I'm sharing. I made mistakes also. You don't go and find out multi-baggers. Okay, you go and find out good companies with competitive edge. Okay, good businesses. Okay, where you invest and you feel the investment will give you returns and over a long period of time. Okay, so when I invest, I don't look for multi-baggers. It turned out to be multi-baggers. Okay, so that is one thing which I need to clarify. Second thing is that apart from the few examples which I will be going to mention today, I got few more. Those I'm not sharing because I wanted to share those examples where I myself had made some comments in value picker or otherwise. Okay, so that I can relate to those examples where you can see that I could talk about it much before when market perceived it. Okay, at the same time I have made some mistakes also. Those mistakes also we are not talking here. You will make mistakes, right? The biggest of the investors will not be right more than 50% of the time, but when they are right, okay, what is important is that how you ride those multi-baggers. So I'm going to talk about that. So I'm taking just those examples where I've written up something about them in the past, and where I'm not talking about the rest or the rest of the one where I've made mistakes. But when I've been right, I've been able to write those. In fact, the examples which I'm saying, they are multi-baggers. In spite of that, I've not sold any of them. Okay, I've trimmed a bit, but I think 2 positions I've trimmed, but I've not sold fully. So now multi-baggers, if you're talking of say here, I'm talking of I'm a big fan of Motilal Oswal, the wealth management study, wealth creator study, what they call, and they have been doing this for last, I think, more than 25 years. So I love that. So I picked up from there when they talk of multi-bagger, and when and their multi-bagger is not 10x, their multi-bagger is 100x over the last 10 years or 20 years. So if you analyze that, 3 insights come out, which according to me is very important. First, and this is I'm talking last 10 years, okay, or maybe 2020 to 2022, 2010 to 2022, okay, last 10-12 years, all were less than 500 crore market cap. Okay, apart from Bajaj Finance, which was 2,500 crore market cap in 2011. It was from all type of sector. Hence, the sector was not important, but the company was important. Okay, so that was the second insight from those multi-bagger study. Third, which is very important, this I have added, 80% of the share price movement happened in less than 20% of the time. Okay, so which means what? You don't know when that 20% of the time is going to come for that 80% of the move. So it's better to hold them through that 10-12 year period, okay, through all the ups and downs. So I'm going to share with you, how I could do that. Now, according to me, okay, the key is the promoter, okay. The promoter is 70-80% of the entire story. So, he's the key, okay. Second is you have a large market potential or a niche scalable potential tapped very early. Okay, I'll talk about it with live example. They have some competitive edge and also pricing power in a big addressable market. Now, how you decide pricing power, that also I'm going to talk, okay. And then you give adequate weightage to time. Now, compounding formula we all have studied, right? In our school, okay, maybe in class 7, I think, or maybe before, or maybe after. Anyway, the point I'm trying to make is that we have all studied compounding at the age of maybe 14, 15, or maybe less than that. So there are only 3 things in compounding. Okay, so the 3 things which you have in compounding are, okay, the amount you have, which is the principal, and the variable are actually 2, because the amount you have is independent. Person A may have X, person B may have Y, C may have Z. So that is not in our it's in individual control, but it cannot be same for everyone. Okay, so I'll come to P later. So the biggest variable is R and N. Okay, and what I've seen over years, including myself, when I started my investment journey 20-25 years back, we always focus on the R, which is the rate of return, and not on T or N, which is the time. So when you focus on rate of return, which means what? We are trying to earn whatever we invest, we try to earn maximum return on that investment in a short period of time. So normally, and this is statistical data, more than 95% of the people have a view of less than 1 year. Now, if you have 95% of the people having a view of less than 1 year, means the person investing is looking at a return of whatever, 25, 30, 35%, okay, for that stock in 1 year's time, right? Now, when you invest in such stock, even if you're right, what you do next, okay? So what you do, you will again have to search for another opportunity after 1 year, or maybe before that, okay? So instead of doing that, if you focus on T is the time, and mellow down your expectation a little bit, okay? So maybe you don't expect 35% return, you expect 20, 25, 26% return, but for a little longer time, even if it is not for 20 years, 30 years, take it for 10 years, okay? Then you actually multiply your wealth 10 times. So you don't need to find multibaggers. Multibaggers will come to you if you actually get a good business which has a competitive edge, which has a right to win, which has a pricing power, and just hang on with it, for 10 years. So you put whatever money you have. It could be 10,000, could be 1 lakh, could be 10 lakh, okay, or could be a little higher also, okay. I typically, tell that when a person invests in a real estate, specifically in India, everyone wants to own a house, okay. So a house in Bombay, you will never get it below 1 crore, right? Okay, actually you have to pay much more than 1 crore, right? If you look for a house in Delhi, the same thing, okay. Bangalore, maybe you will get. Calcutta, you will get, okay. But the ticket size of a house is far higher, right? But when it comes to share market, stock market, when you buy a real estate, when you buy a flat, you don't think that you're going to sell after 1 year, right? So you have an intention of holding it, okay, even if it is for investment purpose, and your holding period is never less than 1 year. It can be 3 years, 5 years, 7 years, I don't know. The optimum time when people sell a house is normally above 7 years. Okay. So now imagine if the same house one a person is buying and have a longer period of 5, 7, 10 years, why can't it be stock like a house? Okay. So the biggest wealth is created in this compounding. Okay. House after a point of time will give return of maybe 1-2% over inflation over a longer period of time, but stocks give much more than that. So if someone is investing 10 lakhs, okay, at a 26% CAGR, okay, for 10, 20, 30 years, you're talking about a huge compounding. Human brain cannot think, okay, when it comes to compounding. People can add in AP progression, 2 plus 2, 4, 4 plus 2, 6, 6 plus 2, 8. But when it's to compounding, human brain is not able to calculate. I'm assuming students here are of the age of whatever, anyone. I'm still a student, okay, I'm not your age, okay, but people normally mature as an investor, start as investing journey around 25 and mature as at the age of 50 is my insight. Now imagine someone, starting investment journey at 25, and that person is going to live till maybe 85. Okay, today our average mortality rate in India, I think, is 73, and every 4 years it increased by 1. So in 40 years it will increase by 10. So average mortality rate of Indians will be 83. Okay, from now in maybe in 40 years time. So people who is 25 who will be 85, okay, they will have 60 decades of compounding. Forget 60 decades, assuming 40 decades of compounding when the person retires. So if a person having 10 lakhs or 1 lakh for that matter, forget 10 lakhs, compounds 4 decades at 26% per annum, that 1 lakh becomes, can anyone guess how much that 1 lakh becomes in 4 decades of compounding at 26%? Please, someone guess. 1 lakh at 26% compounding for 4 decades. How much is the value?
25 crores, 100 crores, 80 crores, 20 crores.
Anyone has guessed?
Guesses are coming at 100 crores, 25 crores, 30 crores, 20 crores.
So what is the lowest?
Lowest guess is 20 crores.
And highest guess?
Highest guess is 1,000 crores.
So, it's very simple. At 26% for 10 decades, it comes to 10 times. 20 years becomes 100 times. Okay. 30 years becomes 1,000 times. 40 years becomes 10,000 times. That is the power of compounding. Okay. So now 10,000 times into 1 lakh is how much?
100 crores people as a comment.
Correct, 100 crores. So that is the power of compounding. So if you do it for 5 decades, it becomes 1,000 crores. So 1 lakh has become 1,000 crores, right? So normally, as I said, people mature, at 45, 50. So even if you take 3 decades of compounding and you want the wealth, you want to enjoy that wealth. Okay, so let's take 3 decades of compounding with 10 lakh rupees. Because you anyway buy you or your parents, you buy a flat at 1 crore valuation. Here we are taking 10 lakhs. So 10 lakhs at 3 decades of compounding becomes 1,000 crores. Okay, so at 26% per annum. Now, is 26% easy? No, it's not easy for 3 decades. Okay, you'll make mistakes, but here we are talking about how we choose good businesses and stay with it for 20 years. If you look at it's simple but not easy. I'll give you a good example. Okay, people 20 years back, the brands and the company which was present in India, okay, 20 years back, I'm talking consumer brands, the same brands and companies are today also there. So what is the difference between yesterday and today? Okay, nothing. The same brands are there. So strong has become stronger. Now, 20 years back, we never knew of ICICI Bank. We never knew of Axis Bank. We never knew of HDFC Bank. We knew. Okay, of course, we never knew of Bajaj Finance. I'm not talking about Bajaj Finance, but we knew all these three companies. Okay, they were in existence before. So instead of opening a bank account with the HDFC Bank or opening a fixed deposit with the HDFC Bank or a ICICI Bank or an Axis Bank, had we opened a 10 lakh, instead of opening a 10 lakh fixed deposit with these banks, had we invested 10 lakhs in shares of these companies? Okay, I work for as I said, I work for Marico, right? Okay, now imagine, if someone had invested. In fact, I'll give my example. Okay, when I joined the company in '99, the market cap was I think it was 300 crores market cap. Today, the same company's market cap, I don't track now. I think it is 65,000 crores. So 300 to 65, you can see the delta. It is more than 100 times. So which means a person who has invested 10 lakhs in Marico, okay, actually makes 10 crores, right? So that is the way we need to think about compounding. Okay, so coming back to multibaggers, what Ian Castle talks about multibaggers. This is one of the best definition on multibaggers and how you need to look at it. So I'll just read it out. Okay, the smaller the company, the more should be the focus on management and qualitative analysis. CEOs of small microcap companies tend to wear a bunch of hats, so their influence is much greater than larger companies. Founders are the difference makers. What's this word? Founders, the promoters are the difference makers. Now he talks about, you need to find intelligent fanatic, okay, in those founders. So what he means by intelligent fanatic is a promoter who have a long-term vision, who has a focus, who has an energy, who has integrity, who has intelligence, multiplied by execution. Okay. Now, if you break this, in simple words, the way I see it, he's basically talking of a promoter who has a good integrity issue. He doesn't have any integrity issue. He's honest. If that filter is taken care, then the way he thinks, which is strategy, multiplied by how he executes, is the result, right? So I don't have a pen and or if I were to do online, offline, sorry, I would ask two things. To me, result is a byproduct. Okay, is a multiplier. It's a joint probability of strategy and execution. So on strategy, suppose on 100, a company is say 80 out of 100, and on execution, the company is only 50. Which means 80 into 50 is 40% on result. So reverse this. Some company on strategy is average, but on execution is above. Suppose strategy is 50, execution is 80, then also it is 40%. So you need to find companies who are high on both. Okay. Strategy is 80, execution 80. Then also your result is 64%. Okay, so the point I'm trying to make is you need to find promoters who are honest, who have a strategic intent in a large pool of opportunity, and the execution is brilliant. Okay, so now how to assess that? This is the most difficult thing to do. Okay, how you assess that? He gives an explanation to what he says. Many investors mistake an executive with charisma for being an intelligent fanatic. The microcap space in particular is filled with snake oil salesmen and executives that talk too much and do little. Don't mistake a storytelling charismatic CEO as an intelligent fanatic. In fact, many intelligent fanatics are not charismatic. Intelligent fanatics let the execution do the talking. This is very, very important. And I'll give my personal example. I don't want to talk about the companies where, where the charisma took over, okay, and I didn't look at those companies in spite of reputed, investors invested in those companies. I since it's a public forum, I don't want to name those companies. I met 2 months back one promoter who was selling his company in the agrochemical space. Okay, uh, and I went to his office, lovely office. Okay, everyone was more interested in the share price of the company than the underlying business. Okay, and there are some good investors who are invested. Okay, so it actually so the point I'm trying to make is that you will have lots such companies. So it's finding a needle in a haystack, right? There are 5,000 companies and you're trying to find those 10-15 companies in that 5,000 companies. So the noise is huge. You need to cut the noise. You need to have your own view of cutting the noise. Don't copy others. When I'm making this presentation also, please don't copy me. Okay, you may get only one sentence out of the entire 1.5 hours presentation, which may be worth looking at for you. There may be 99 things which may be rubbish for you. You cut those 99 rubbish from your perspective when you're listening to me, but take that 1%, if it at all impacts you from this entire presentation. But that 1% will make some difference in your investment. So cutting the noise is very important. So now, luck plays a very important role, okay, in investments. So I'm going to talk about 4 examples here where luck played an important role in me identifying those multi-baggers. Okay. Now, we underestimate the importance of luck. I've been extremely lucky, let me admit to y'all. Okay, now here I've written ITC as an example. You would be thinking that I'm writing ITC as an example. I've got lucky in ITC. Actually, I've been very unlucky on ITC. So I've been from the FMCG industry. I worked in FMCG out of my experience of, the years I have put. FMCG has been a major chunk. I've worked in FMCG and retail. So FMCG has been a big chunk of my overall experience. So I assist ITC in 2018, 17, 18. Okay. And I normally write a note to myself. I wrote a 13-page note to myself. And this is the best ever note I wrote in the last 20 years. I invested in ITC, a little below, I think, 300. I held it for 4 years. Okay. And I lost patience. I exited. And you imagine what ITC has done in the last 1.5 years. So, and this is the best ever note when I'm saying is that I analyzed the company beautifully well when I look at that notes. In spite of that, I lost my patience after 4 years. And what has changed? You have those jokes coming on ITC every now and then, right? Those memes coming in. Okay. And that was going on for quite some time, So now when I look back, nothing actually has changed for ITC. ITC, only the perception has changed. And then I'll talk about it more later when it comes to perception, how market, values and changes perception quickly from one end to the end. Okay. So long story short, ITC, when I analyzed and now there's no difference. Okay. They had more than 50% ITC's revenue comes from cigarette business, and more than 80% of the profit comes from cigarette business. This was 4 years back when I wrote the note. Today also it is the same thing. FMCG was contributing insignificant portion of the profit. This, when I wrote the note, then also it was there. Now also it is there. No change. Capital allocation in the hotel business then also was very bad. It was making just 1 to 3% of ROE in the hotel allocation, and the hotel allocation was 30% of the total capital employed in the last 10 years. Has that changed? No. So what has changed actually? Okay, there was a ESG overhang before where institutions were selling right, left, and center. That ESG perception has changed a bit. Okay, when I wrote the note also, ITC one was one of the best managed company on ESG worldwide. Okay, so all these led to believe that market will change its perception, ITC will give good return, and hence I invested. So the learning for me is 4 years is also too short time, to lose your patience. So I held it for 4 years. Forget making money, I lost money. I think, I bought it little below 300 and I sold it little above 200. Okay, I lost money in 4 years. And today, while that position, I switched to my winners. Okay, but in the hindsight, if I look back, all negatives were factored in. It had a beautiful dividend in which was one of the reason of me investing also at 5% dividend in. But still, being veteran for 20 years in this investment world, I made the mistake of not holding it beyond 4 years. So 4 years is also a short period, when your patience gets tested. Now, coming to the second learning on multibaggers, check your skillable metrics. When I used to be in the industry as PO, I used to take people, I used to interview each and every person, right? Specifically at a senior level. And I used to check their skillable metrics. What I mean is, I used to rate them on skill and will. So I would take a person who is high on will, but medium on skill. Because to me, skill can be taught, will cannot be. So why I'm telling you this from an investment perspective is, focus on your core competency and build that competency. Okay, now where the will part comes, will part is that when you're building your competency, you have to be better each and every day, and increase your circle of competence. Every passing year, increase it. As I said, I'm a FMCG guy. For me, it is very easy to invest in FMCG companies, but do I have the right valuation? No. Okay, as I said, ITC was at the right valuation. Did I have the patience? No. So the point I'm trying to make now, in Indian context, if I have to invest in FMCG, I'll never get a chance. Rarely I'll get a chance. ITC is a rare example. So what I do, I don't invest. I have to invest. So I need to increase my core competency and increase it to adjacency, and there the will comes. So over the last 20 years, okay, I don't think, when I was doing actually job, I was reading 2 to 3 hours every day. Okay, one of the reason of leaving my job, because I felt I need to read more. Okay, so today I read 7-8 hours, okay, which I was not able to do. So because of this, okay, my ability, the width of my reading has increased, the depth of my reading has increased. Earlier, where information was an edge, when I started my investing journey in 98, 99, information was very difficult to get. Getting an annual report was very difficult. But today, information is not an issue. Okay, today I use ChatGPT. Okay, I wanted to analyze a company. I wanted to get the companies, not that company, the sector growth, or what are the companies which are in that sector in India, globally. Everything I got in ChatGPT. Everything, and it took me. I just wanted to time it. Earlier in 99, 2000, it would take 2 months to get some meaningful data. Here, it took me 51 seconds to get category information, the companies which were operating in globally and in India. 51 seconds in ChatGPT. I have a premium version. Maybe it's a little faster. Okay. So now information is abundant. Today you have WhatsApp in university, right? You have so many websites. You have social media, Twitter. You just have to give the search and everything comes. Chat GPT gives you in a platter. But that is information. How you convert that information to insight, that is more important. So there the will part comes into play, where you think that you should be better when it comes to insight, wisdom, okay, and you don't have only information, you're able to convert those. So that's very important. Stay foolish, stay hungry is Steve Jobs, he rarely gives lecture. So this is a lecture which I saw maybe 14-15 years back, and it had and I had saw that only once, okay, and that has a very lasting impact on me. So give a Google search and find out what Steve Jobs said, I think in 2004 2005 in Stanford University. He talks about three things. First thing, he talks about what you are today is a factor of your past. Okay, past means past experiences. So he connects, says that you need to connect the dot. Okay, I don't know, how many of you would know that he came to India in, I think in 70s. Okay, if I'm not mistaken, early 70s, and he met a saint. Okay, he understood, and he was on after he went back. Okay, he had a very bad uh, I think health issues, okay, relating to stomach, loose motion, whatever. After that, I think, if I'm not wrong, he never came to India. Okay, so then he became vegetarian after his India trip. So there were a lot of positives which got added, but there was a lot of negative perception was in his mind because of his connecting the dot issue. Okay. For example, he did a calligraphy course. Today, Apple design comes from because he had done those things. So when he talks of connecting the dots, I'm just reading too much into it. Okay. What Apple is today is because of Steve Jobs of past. Okay. Because of the way he thinks of design, the way he thinks of things. Imagine in FMCG or any matter, when you want to get into something, you want to actually find a need gap in a particular area, and then basis the need gap, you create a product and a communication strategy to communicate, right? So Steve Jobs doesn't do that way. He's saying that how a customer will know his need gaps when the customer doesn't know what she needs. That's a completely different way of thinking. Okay, and he got this thinking by keeping his ears and eyes open. So his philosophy is, you whatever you are today or what you're going to be tomorrow is of these connecting dots. That is one. Second, he talks about that stay hungry, stay foolish. And third, he talks about, you should do things which is important to you as if today is the last day. Anyway, if you'll give a Google search on Steve Jobs Stanford University lecture, nice one, a short one. As I said, the third one is cut the noise. Fourth one is very important. No, this is very important for me. No trade is also a trade. I love options. So, I trade in options. That's a different subject. I have option trading platform. I don't take money from others, but that platform is for me to also, in a way, be in options, which is also one of my passion. So there, I always tell to myself and the programmer who I use to develop and constantly upgrade the platform, is that no trade is also a trade. Similarly, no investment is also an investment. Okay, I'll give you a personal example. Okay, and before that, in today's environment, if you see today is a euphoric bull market, right? So you will get to know about a lot of ideas from your friend, your, anyone, you're talking to. Okay, the market is euphoric. So in this, how you control your greed is very, very important. Okay, so no trade is also a trade. Keep that in mind. So as I said, in 2017, around 2017 end, I felt the market was overheated. Okay, so I was on 30% cash. Okay, 2017 end, yeah. So that's 30% idle cash I was keeping, thinking there'll be a global recession. Okay, so paying too much to macro also doesn't help. I sat on that cash for 4 years, 2017, 18, 19, 20. Okay, to some 2000, yeah, 3.5 years to be precise. And that money was actually not invested anywhere. It was not fetching, normal rate of interest. I was getting calls from my banks that, sir, you have large amount of money. Why don't you put it in a short-term fixed deposit? I didn't do it. It was fetching zero return. I was expecting a global financial crisis or global financial recession. Being in the market for 20 years, sometimes you have seen so many cycles, so that acts as mostly as an advantage. Sometimes it's a disadvantage also, because I've seen the cycle of 2000, right? I've seen the cycle of 2007, 8. So I was predicting something is going to happen. It's too long a bull market. Nothing happened. My cash was giving me zero return for 3.5 years. And then COVID happened. Okay. Now, when COVID happened, I still couldn't deploy 30% idle cash. I deployed little over half of it. And here, I would say I was lucky. The reason is no one predicted COVID, neither was I. I was predicting some kind of recession. The market tanked, 30, 40, 50%. My portfolio was down. But I had the conviction, okay, market is going to go up. Okay, which is why whatever I deployed during that time has beautifully, beautifully worked out. Okay. Now, still I could not deploy fully. Okay. So, there is no right, wrong answer. You need to be mostly right, then majorly wrong. And when you're right, just ride it. Ride your investment and constantly evaluate your investment on terminal value. Okay, I will talk about it a little later. So behavior is key, and I strongly advocate people who are really interested to make investment as a career, or to make investment as a part-term career, or to be in investments along with your job. In either of the situations, attend 2 courses anytime. Okay, in the next, the earlier you do, the better. This is the best value investment advice, which if you are to ask me to take only one takeaway from the entire presentation, I would say take this takeaway: two courses in investments. One is investment with masters in the Flame University, where it's a rigorous 5-6 day course where 25 30 speakers comes and speaks, and they are market veterans. The second one is Professor Sanjay Bakshi. Okay, this happens around July, August. Yeah, July, August of every year. So keep a watch on that. So I'm going to talk about these 4 investments. So Arman Financials, RDCL Geotech, Tata Elxsi, and Angel Finecap. If you see, the first purchase in Arman I made in 6 years back. RDCL Geotech, Tata Elxsi, and Angel Finecap 3 years back. So if you see my first entry price, this is the first entry price, which means after this also I bought. Okay, maybe on the rise, maybe when it corrected, but the first price was the price I mentioned here. And I made this presentation, day before yesterday. The price was this. I was talking multi-bagger returns, right? Multi-bagger is 10 times. So if you see on Arman, I got close to 10 times from the first purchase. RECL Geotech is 18, 19 times. Tata Elxsi 9 times, 10 times. In fact, this is not from the peak. Tata Elxsi actually moved, I think 9.5 to 9.5, 10,000 it went to. Okay, I have taken the price which is now. So Tata Elxsi another 9.5 times. LG Fancam again, it moved to I think 3,500 plus, which is more than 10 times, came back. Now it is 6.6 times. What is interesting is I never wanted these, or I never knew that these are going to be multi-baggers so fast, so soon. I never knew. I thought it was a good investment and I invested. It turned out to be multi-bagger. Okay, so I will share my insight. So first insight on any investment: good management with strong execution skills and skin in the game, because you're betting on the jockey. What I mean by skin in the game is the management. When I'm saying management, I mean the promoter or the management. It could be same, it could be different. So basically, the promoter's skin in the game should be very high. What is skin in the game? People look at promoter holding. One of the ways, of course, promoter holding should be more than 50, 55%. The other way is, even if his promoter holding is less than 55%, his net worth should be 95% of what he does and not dependent on something else. So that is what I mean by skin in the game. A company which has competitive edge, right to win, okay, which means have clear strategic intent for years to come. I can clearly see sustainable, profitable growth for next 5 to 7 years. All three words are very important to me: sustainable, profitable, and growth for long period of time. Company should have pricing power, available at reasonable valuation, which we all want, right? Now, after that, what you do, you if you have got this right, okay, then you focus not only on that compounding formula of what I showed you all, where you focus more on the T. In life, also focus on the T, which means you focus on health, happiness. Money will be a byproduct if you have done the investment right. That doesn't mean you just invest and sit quietly and then wake up after 5 years, 7 years. No, you constantly need to evaluate your investment. When I say constantly evaluate, I'm not saying constantly evaluate every day, every week, every month. In fact, I'm against this QSQT business, quarter se quarter tak. I am not at all interested. I have run two listed companies, so I have been on the other side of investment, where I saw investors are only interested in the quarter numbers and what is the projections next quarter. Business never happens that way. Okay, you cannot project quarter on quarter growth for any business. The CEO or the promoter can also not tell, and if he is telling so surely, okay, then you have to be careful, because you can have a you can have a guideline for growth, but you cannot have specific growth that I will grow at this percentage. People may guide you for a growth. Okay, business doesn't happen in a linear way. I've handled business, right? It cannot happen in a linear way. So you need to when I'm saying focus on T in life and sit tight, I don't mean that you do your investment, wake up after 7 years. You constantly evaluate, but the evaluation should not be of the investment on a quarterly basis or a weekly basis or a daily basis. Okay, evaluate it every 2 years. Okay, on a terminal value, whether the business still has terminal value. Okay, I will talk about terminal value later. Money should be made when you sleep. Okay, this is Warren Buffett is, I'm a big fan of him, and the best quote which I like is this: your money should be made when you sleep. Hence, follow the process of hunting, not the hunt itself. You follow your own process. Don't copy anyone. So this is my personal insight on multi-baggers. So what you need to find, earnings growth. This is not coming. You need to find earnings growth. I'll show it. Yeah, you need to find, this is what I'm saying, you need to find earnings growth. A few themes I have pointed out here which will help you find earnings growth. Okay. For example, okay, how you get to a multi-bagger? You get to a multi-bagger when suddenly you are doing some profit and the profit, jumps. When the profit jumps, what happens? The market gives you a P which is higher than the previous P. So your multi-bagger, if profit is you're doing at 15%, goes to, and the P is at, for simplicity, I'm just putting at 15 times. If profit growth grows from 15 to 20%, the P doesn't move to 20. The P moves disproportionately. So the biggest alpha which gets created, not from the earnings growth, it comes from the P re-rating. I have some data which I'll show you. So which means for you, you don't know when the P re-rating will happen. You also don't know when the earnings growth will increase. You need to find out those situations which gives you earning growth. For example, Tata Elxsi, suddenly it was a consistent profit growth. Suddenly the profit started going up. So you need to analyze why it is going up. Even if you are late in analyzing by a quarter or 2 quarters, you may not have got, Tata Elxsi at 700 odd rupees. But after 2 quarters, you could have got at 1100, 1300, 1500. Still it has gone to 7,000, 10,000. You would have been a late entry to the multi-bagger, but you still would have got it because you are there for long haul. Second is operating leverage. Works beautifully in high gross margin business, which have low capacity utilization. Okay. So, for example, a business like SEBI, okay, because a high gross margin, low capacity, suddenly the capacity is increasing, which is a leading indicator. There'll be operating leverage on the profit. Completion of major capex. When Deepak Nitrate a few years back announced the capex, it was a huge capex. So when someone whose 98% net worth is stuck in his business and he's doing a jump shift growth in capex, you know that the top line is going to come because he is confident. That's why he's putting money. He has skin in the game. Today we invest maybe 2%, 3%, 5%, 10% of a portfolio, but that guy has 98% of his money stuck in the business and he's doing a major capex. So if he's doing it, he knows. So you need to see his past track records of when he has done capex. If the track record is good, go and believe him. Okay, if you've done good work on him as a promoter and saw his business model and his execution capability. Another theme, what happens when you get those, when you want to find earnings growth, split of business actually gives focus, okay, to the business which is getting splitted, both the businesses. So normally you see earnings growth in such type of business. Keep a watch on those. Sometimes extraordinary one-off is actually deflating the profits. Okay, you need to see when these one-off goes off, sudden increase in profit happens, market sees that, re-rates the PE. This is another thing, change of perception. Now, when change of perception happens, when there's a change of management or change of owners or change of CEO, okay, or when there's a new theme which comes in the market. So because of this is the only exception where, because of change of perception, before the earnings growth come in, okay, the P gets re-rated. So you need to keep a watch on these kind of events and be in a company where who is the market leader or the top three, you'll make money. Okay, for example, when India was laying down the ethanol policy, 3 years back, that time, I wanted to see which are the big companies in the ethanol space. Okay, so sugar was sugar. So I studied Now here when I was talking about, skill will matrix, I never knew about the sugar industry. I never knew. Okay. It took me 1 month, okay, to study sugar industry. Whatever was available on net, I studied everything, including what happened in Brazil in early 90s. Now imagine what happened in Brazil in early 90s. Why I was studying that? I was studying that because I felt what Brazil had did in terms of policy changes in early 90s. That same thing India was doing in early 2020. So if it has played in Brazil, it will play in our market also. So who were the top leaders when it came to capacity? It was Balrampur Chini and Sri Renuka Sugar. So I betted on both those and I made money in both those. Okay. It took me 1 month to study that sector. Okay. In spite of everything available, right? So what I'm saying is that be open to ideas, increase your core competency, increase your adjacency of your competence, read and read. Okay, most of you, I'm assuming, are into part-time investments. You may not get 7-8 hours of reading the way I do. Okay, and you should not leave your job now at this stage, because you need to have capital to compound. You need to have that T to look at T. So put 2 hours of reading, which is perfectly possible. Keep your eyes open, cut the noise, read and read. Again, renewable is another area which I am very bullish on. Okay. Again, this I've spent, I think, again, more than a month reading the entire renewable space, and I'm still reading because, it is so vast an area, and you can have multiple companies in multiple sphere which plays on, and as I said, the change of perception happens before the earning growth. Okay. This is the only case where you need to identify, those companies which will benefit. Ideally, stable company, stable promoter, stable management who have been in the business for at least 20-25 years. Okay. And bet on those. Okay. For example, in renewables, I bet on a group called Worry. Okay. Which has a parent company which did private placement, which I didn't take part into because of different reason. Okay, but where I thought, why should I get my money stuck in private placement? I don't know when the listing will happen, but the promoter is good, have a very sound track record, uh, and also of good execution. So I said, let me play through the listed two entities. So the listed two entities is Worry Renewables and Worry Technology. Now, Worry Renewable is a EPC company, okay, where you are able to see earnings growth, and hence it has given good CAGR and share prices. But Dinora is a, I would say, for lack of better words, I would say a complete black box, because there's not too much of information on Dinora. It is an Italian multinational company. In today's world, where you have so much of information, when I researched on this company, I think 7-8 months back, and after studying for a month, I invested. Today it has doubled, but I'm still not comfortable in putting extra money, because it is an Italian multinational company, have great patents globally and in India. Reliance have given a good order, but they don't have analyst presentation. There is no research report. Okay, so what I do, I cannot, just bet on change of perception. So normally I invest in tranches. Okay, so 1, 2, 3 tranches. So here I've invested the first tranche, and I'm still hoping to meet the management during AGM. And once I get clarity of my questions which I need to answer, I will invest further. So why I'm talking about this, the reason is that though there is not much information, whatever is available, I've read everything, including the website of the parent. I listened to the parent's con call, which I'm not supposed what I will get, but I just wanted to listen to the parent's con call to gain my knowledge on the company. So the parent is Italian multinational company. Their website is brilliant. Okay, if someone wants to understand renewable, okay, you can go to the Italian parent's website. You can go to Denora India's website. Okay, it's beautiful to understand renewable as a theme. So when you are looking on insights, if you ask me personally, if you get the earnings growth right, P re-rating will happen, and these are the themes where you get P rating, consistent profit growth, operating leverage, completion of major capex, split of business, extraordinary one-off write-off. The third is an exception where before the earnings growth, the P re-rating happens, and there you played smartly. Now, before next 3-4 slides, I will quickly pass through just to show you when P re-rating happen, what happens to the share price. So these are Motilal Oswal Wealth Creator Study. So I'm just going. I'm showing three charts of the Wealth Creator Study. So the biggest wealth creator. Okay, so biggest wealth creator means they're talking about large caps, right? If you see this green arrow, the profit has moved. If you see these are individual profit figures, and this is the top 10. The profit growth CAGR in this 5 years has been only 13%. But the price CAGR has been 27%. Share price CAGR. Now, when profit grows by 13, the share price should also go by 13, but it is 27. Why? Because the P has got re-rated from 19 to 34. This is what I was trying to tell you. Same goes with fastest wealth creator. Okay, fastest has nothing to do with size. They can be small, big. Okay. Again, if here you see, in every cases, okay, apart from one where the PAT growth, the CAGR growth has been more than the PAT growth. Every cases, apart from one. Why? Because in every cases, the P has got re-rated. 17P and 22P. So this happens when profit keeps coming in. Okay, the market rates the P higher, and your price CAGR is always more than the earnings CAGR because of the P re-rating. Same goes with most consistent. Same story. So which means this is this is reality. Now we need to find out. I will share my experience on the multibaggers which I could get. Again, I'm repeatedly saying, maybe for the third time, don't look for multibaggers. I never looked at it. I was looking at good businesses run by honest promoters, capable promoters who had skin in the game. Okay, large headroom for growth, who had pricing power, and I invested in good businesses. Okay, they became multibaggers. So I'm just giving you, I normally write a note to myself on every investments I do. Okay, so what was my personal experience on Arman Financials? MFI is a structural growth story. If you look at MFI, in the last 30 years, this is one sector which has grown by more than 20% for the last 30 years. In fact, for the next 10 years also, it is projected to grow at 20%. Now imagine, technically, if you got the sector right, which means if MFI sector is going to grow by 20% plus, if you've got the company right, your portfolio will also grow by more than 20% if you got the company right. Now, to get the company right, how you will get it, that is the key question. So I'll come to that. MFI is not a lending business, but a collection business. So what I looked in Arman had robust collection system. Okay, promoters were very humble, human, down to earth. Okay. Now there was a change event also which was happening. Okay, they were earlier into two-wheelers and three-wheelers. They moved to MFI, and with the successor, which is the son, Jayendra Bhai is the promoter. His son is Alok, who actually studied in USA, and during he saw Lehman crisis. He's a CPA, and he saw Lehman crisis, because of which he was extremely conservative. Now look at, if you are in a lending business, anyone is there's everyone who wants to take money from you. Okay, but there will be, so it is, to me, it is not a growth business, it is a collection business. If 100 people comes, you have given money to 100. I can give money to 120 people also, right? But the question is that my profit lies in the last EMI whom I have given money, right? So what is important is not the growth of the business. What is important, how the collection system works. So these guys, had a very robust collection system. Their incentive model was linked to collection. Okay, when the market had a 1% NPA, they were actually disincentivizing their sales force for collecting anything less than 99.5%, which means what? By design, their net NPA would be 0.5% compared to the market, more than 1%. A sector which was growing by that 20%. And then I have very humble, human, down to earth, promoters, where the promoter himself goes to the market and spends time with the customers and the field force. And then you have a successor who has come from US. He's a CPA, finance guy, and is also conservative. And then you see the past track records. Past track records, ROA of above 4%, ROE of above 20%. Cost of operation was very less. Then what you need? You just, invest. Okay. The only issue in this is, in MFI, there are cycles. What I mean by cycles is that, you will have cycles of, there was cycles of flood in every geography. There will be, in some geography, sorry. Then there will be issues in terms of, loan waivers by a particular state government. Okay, then there, Demon was a black swan event, COVID was a black swan event. These were black swan events that normally doesn't happen. But these black swan events earlier used to happen once in 10 years. For example, AP crisis happened in 2010 and 2011. It didn't happen after that. But these Demon happened, COVID happened. We don't know what can happen in future. But whenever these kind of events happen, the strong became stronger. So if you are with a player who in a structural industry, in an industry which is cyclical, but have a if you take a long-term period instead of taking short cycles. So instead of looking at a business for 2 years, if I stretch the business for a 5-year cycle, in 5-year cycle, these guys have consistently made ROA of 4% and ROE of 20%. And you have a solid promoter whose 98% net worth is stuck in this business. Okay, so then you have a clear winner. This is, I used to earlier write in Value Picker. Okay, this I wrote in February 2020. Okay, the share price has shot up. Okay, now share price has shot up, I think, from 300 odd level in 1 year's time to 1100 odd level. And someone asked me in Value Picker, what is my view? In spite of going to 1100, to read this note in this presentation, I think will be shared by Ishmoy to all of you, or you may be able to download it from the website. If you see this, I'll not read it, the entire thing. So basically what I'm saying is that I'm answering to someone who has written to me that I don't look at share price. Yes, share price has gone up too fast, too soon, but you need to see along with the current path and what they're going to do in future. I normally follow the underlying business and how the leading indicators of the business is showing up. then the share price would follow, and hence cannot comment on the share price valuation. Okay. So what I am telling is that being a CA and also having myself run business in the past as CEO in different countries, I can reasonably say that the PAT in next 2 years would cross 100 crores if no black swan event happens. We never knew COVID is going to come. Last year, the PAT was only 21 crores. Now, if you put that context in mind, where PAT grows from 20 to 100 crores in 3 years, approximately 70%, then when it goes at ROE of 30%, post 3 years, market will recognize this sooner or later. Now, imagine two things. One is, I am saying don't look at share price, follow the underlying business. If this is, I'm telling in February 2020, when I never knew COVID is going to happen, I'm saying if black swan event doesn't happen, their profit will go from 21 to 100 crores. Now, what happens? Actually, a black swan event happens. Okay, their complete profit of 21 crores in 1 year's time gets wiped out to zero. And then it has gone to 93 crores in 3 years' time, in spite of the black swan event. Now, what I told not to look at the share price. Now, what has actually happened to the share price? In February, March, I think it went to 1100. And you'll be shocked to know, in the COVID, in 2 months' time, the share price shot down from 1100 to 300. Now, that is the time where your conviction gets tested. This is a what you call company which I had identified very early. I had shared with some of my friends. Okay. Apart from, I think, 1 or 2%, most of them sold. And I was the person at 300 also I bought. So if you have done your homework very well, okay, if you have met them in the AGM, if you have met them otherwise, if you have worked in the market, if you have done your homework thoroughly well, okay, then you are not looking at share price, you're looking at profits, because I have in mind 100 crores of profit in 3 years' time. Okay, COVID may have taken away 1 year. I thought it will happen in 4 years' time. To my surprise, in spite of COVID, it has happened 3 years' time. And as I was thinking, because of that, what has happened? The share which was 300 during COVID is today is at 2200. This is the share price. See the big drop, and then it goes. See the volatility in the share price. See, I was telling you 1100. In 2 months' time, it dropped 71%. It dropped 30%. It dropped 28%. It dropped 24%. It dropped 21%. Like Ramdev Agarwal says, wish to buy and patience to hold. Okay, is the only philosophy you need to have in life. Okay, when it comes to investment, make volatility your friend. You know, the biggest difference between Rakesh Jhunjhunwala and anyone else, it is not the courage to buy Titan. It is the patience to hold. I had done some analysis a few years back on Titan. Okay, why he's a great trader and a great investor? Because he is the only guy who could hold Titan for more than 2 decades. In spite, every 2 years, Titan has fallen 30 to 40%. Now imagine Titan falling 30 to 40% every 2 years. Imagine Rakesh Jhunjhunwala, his portfolio is 10,000 plus crores. I don't know now the present count, maybe 15,000 plus crores on Titan portfolio, and dropping 30, 40% in every 2 years means what? His portfolio drawdown is 4,500 to 6,000 crores in every 2 years, and still the person is able to hold. Because what he is seeing is not today. He's seeing 10 years, 20 years, 30 years down the line. His portfolio, okay, has compounded at a massive rate. One of the reasons is Titan. He has a long tail of investments. He has more than 30 companies. But this titan, most of the time, has contributed to 35 to 45% of his holding and net worth. Same goes with Warren Buffett. Look at Apple. Apple is more than 40% of his holding. So the point I'm trying to make is that if you are convinced and if you have done your research right, okay, it's not about buying, it is about holding for a long period of time. Same goes with my second one. This is RSL Gear Tech. I'll go a little fast because it's more than 1 hour now. Okay, so RSL Gear Tech. Now this company, you see the character of the promoter. The company went into BFIR, okay, into liquidation when they had only 13 crore turnover and 55 crore debt. The company plant head was Gursharan Singh. Okay, so when the erstwhile promoter was not having confidence, this guy, being a technical guy, okay, comes up and says that he wants to take over the company. Okay, so he takes over the company. He gets the same people who used to work with him. Okay, and then what he does, he says that I need to be focused on quality, technology, and timely delivery, and I will focus on export market because export market will understand my technology. Okay, I will be able to service them where I'm supplying to them, or I'm looking a solution to their brands. I'm not serving I'm not servicing a ready-made product. I'm actually finding out solutions for them, and giving them the assurance of service and quality. Okay, and that was a simple but effective strategy. So what happened because of this? A Japanese company called Kubota, they realized the quality, what RSL could service, and today they actually, after 2 decades, they still service to Kubota in 4 geographies, including giant, China and Japan. This is what I wrote in June 2020 when the share price was 65 rupees. So they had a very respectable client, okay, had good pricing power. Pricing power you can gauge by operating margin. They had an operating margin of more than 20%, okay. And imagine the way the promoter came. He was almost he took a company which was almost bankrupt, okay. And he not only took a risk for himself, he took a risk for his entire family, entire employees working there. Now see this is a note which I made to myself, and this what you're seeing, the brands, this was then at that point of time. I picked it up from their website in June 2020. These are the customers they are servicing. Imagine these customers, Kubota of the world, Yamaha, BMW, okay, KTM. These customers are in Europe. Imagine in Germany, okay. These big companies, which I've analyzed the underlying companies. Okay, the underlying companies in Europe, their market cap was anything between $2 billion to $100 billion. They giving order to a company situated not even in Delhi, in Noida, to a small place which is not near the port, and asking them important parts for their dedicated models of the car, which means something this company has, right? And that time I think it was quoting at 5p. Look at what happened. The 65, the share price has multiplied 18 times. Look what I was telling you. Compounded growth rate, if you see, compounded growth rate for the last 37 years. So last 10 years is 37%. Last 5 years is 37%. For last 3 years is 27%. Okay, and for the last 1 year is 52%. But what is the share price doing? Share price has shot up. 10 years 53% CAGR, 5 years 80% CAGR, 3 years 148% CAGR, 1 year 110% CAGR. Return on equity consistent 23, 24, 25. So why stock price CAGR is more than compounded growth? Because again, as I said, the P which was 5 have got re-rated. Let's see again. What was the past background? Okay, by the way, Tata Elxsi, when I invested, it was small cap. I think 3,500 market cap. Now I think it is 50,000 market cap in a span of just 3 years. Tata Elxsi, now here you don't have to do too much work on the promoter. We all know we have huge faith on Tatas, right? So what was the past background? Past background was, because of their acquisitions, Jaguar became their client, and Jaguar was contributing to 20 because of past acquisition of Tata Motors. Jaguar became their client, and this customer was contributing to 25% of the total top line, right? And this is a note which I wrote then. Okay, that point of time, that 25% became 16%, because of which, okay, the automobile vertical was not doing well, and automotive vertical was more than 40% of the contribution. Since it was not doing well, Tata Elxsi shares got beaten down. Okay, so what they did, they were trying to de-risk their strategy and was focusing on, media and broadcast vertical, and they were focusing on healthcare vertical. Now they are in the ER&D space, engineering, research and development space. Okay, this space has a huge tailwind, and I just got purely lucky. I never expected this tailwind will get fast tracked because of COVID, and the working from home and onshore offshore split will get changed. Just got lucky. Okay, but the hypothesis was, they have good accounts, they have good partnership with Google, Microsoft over the world, they have good clients like Netflix and all the good automotive companies and all the good healthcare companies. Okay, huge macro tailwind when it comes to ER&D space. You have close to more than $200 billion spent which is going to come. Okay, so marquee clients they had. Okay, and the stickiness of the client was high. Okay, so all were there. I was not looking at a multi-bagger. I was looking at consistent profitable growth because of the tailwind and because of good promoter and good pricing power, which I gauged through operating margin. That time was more than 20% again. So what changed? I got lucky because, tailwind of COVID, everyone was working from home. These guys, onshore offshore split became favorable. Okay. Now look at their capability. If anyone follows Tata Elxsi, you will see. Last week I think they won an order from ISRO, where ISRO first time is actually outsourcing mechanical design, and they have done it to Tata Elxsi, which speaks about their capability. Right now, I'm still invested in it. This is one where so you need to be invested in companies, constantly evaluate the terminal value. If you are not comfortable in holding the entire position, trim the position so that you book some profit, but don't go away from it, is my advice. You find the winners. So this is Tata Elxsi's consistent profit growth, but the stock has got re-rated. Last 1 year there has been a correction. Okay, it will not go in straight line. You see this drop has come in because the P reached 100. Okay, now it is at, I think, 60. Still it is overvalued. But if you look at the terminal value, we'll talk about terminal value a little later. If you look up the terminal value, is it overvalued for the next 10 years? No. Is it overvalued today? Yes. Is it overvalued next 2 years? Yes. You have two choices. You actually have many choices. What are the combinations? Trim some positions. Second is that sell everything and buy again, which is very difficult to do. Okay, so better trim some position, stay in it. SGL find again, another find. These guys are in animal APIs. Okay. So this is an extract of a note, 7-page note, which I wrote to myself in 3 years back. So they are into animal API. They in the top 5 product. That time when I wrote, they had a market share of 30 to 50%. As we speak, in the top 5 product, they have a market share of more than 50%. And the next 5 to 10, they again have a high market share, and the market share is increasing. Their growth were supposed to come from new categories, new product they plan to launch, to 4 molecules. And again, they had a very high operating margin. I thought, see, this is the note which I written to myself. Profit should be at 18-20% for next 5 to 7 years. And hence, logically, the share price should be 10x in 10 years. It actually became 10x in, I think, 3 years or 4 years, and came back to, I think, 6.5 now. I'm still holding it. Okay. But I'm saying just project the profit growth. Share price growth will follow. This is NGL. So this is a way of checklist which I have been through. Okay, all throughout. I've just put this checklist, which is my checklist. You have to have your own checklist. Don't follow me. Have your own checklist, and if some of the points make sense for you, you can follow for yourself. As I said, promoter is key. 70-80% is about him only. Try to meet the promoter during AGM or otherwise. That will help you in getting the convictions to stay invested. See, when I talked about Arman, okay, when your portfolio you invested, it went up quickly 4 times or 5 times, and then it corrects in 2 months 71%, right? So that time, most of the people will be shaky, will sell out. Now imagine someone selling out a position at 71% drawdown, and then it goes up 1,000 times in the next 3 years. What will be that psyche of that person? So you are hit on both sides. So instead of that, if you have done your homework, if you have met the promoter in the AGM or otherwise, and this is a temporary blip, it will come back after 2-3 years. Okay, and there is a tailwind. Okay, and they have an edge. So just stay with it. Okay, that doesn't mean you blindly stay with any position. That is very, very important, because cutting losses is very important. Okay, your ability to judge whether the business is structurally changing. Don't look at share price and decide that structural change. Look at the business and see whether there's a structural change in the business or not. This I didn't talk about, it is also very important. See what problem the business is solving. For example, Arman providing credit unbanked in a cost-effective way. RACL was providing solutions to automotive industry and not just sell what it had. Tata Elxsi was providing unique design and technology services. You imagine Netflix is your client, right? Your Google is your client. ISRO is now their client. This speaks about their capability, right? NGL is finding innovative, cost-effective way to make cost-effective way in complex chemistry. Look at business competitive edge, right to win. Okay. For example, Arman's right to win is credit to unbank in a cost-effective way. RACL's right to win is sitting remotely in Noida, servicing $200 billion companies in Europe. Tata Elxsi sitting in India with a unique solution, servicing to the great technology companies in the world. NGL sitting in Bombay, giving cost-effective solution to a 7-8 chemistry, complex chemistry processes. And all these, you need to find out whether they have an edge, from where the growth will come, and when the growth comes, If you have a good margin, the operating leverage comes into play. All these companies had an operating margin of more than 20% and return on capital employed of more than 15%. So you are actually filtering the companies basis the management, tailwind for growth, their past track record, and pricing power and capital allocation. So this is what I follow. What I do is that I have a core portfolio. I'll define core and seed portfolio. So on a constant basis, I have 5 to 8 companies with only 2% allocation. Okay, so when you have 2% allocation, if it's 5, 10% of your portfolio is seed. If you have 8, 16% of your portfolio is seed. When I mean seed, what I mean, these are small companies in phase 1, phase 2 of their growth, right? So I'm observing them. Okay, I am doing my research. I am, meeting people. I'm meeting competition. I'm meeting industry leaders to find out how the sector will do. I'm meeting fellow investors to take a point of view of them, okay, of theirs. Okay, I am also going to AGM, meeting the promoters, okay, talking to fellow investors. I'm working in the market sometime to understand, the company. And then as and when I see my conviction can grow through the process I follow or the numbers coming in, right? So if I allocate 2%, okay, and if my conviction increases or the number starts coming in, I increase the size, which means if I have to invest, I'm just giving example, suppose 100, I will invest in 33, 33, 33 or 50, 50. So first I invest say 33, my conviction gets built, okay, my the numbers still coming in, then I put the next 33, okay. So, or if I've put 50, I put the next 50. So now the next 50 may be at higher prices, and in fact I want it at higher prices, because higher prices means what? The business has performed, my conviction is there, okay, and the re-rating will also happen in future. Okay, sometimes I buy at lower prices also. For example, NGL Fine came, I bought before COVID, I think, and then after COVID it came down, okay, without any movement in the business or my conviction. I added 1/3 again, so I was 2/3 in the position. And then I went and met the promoters, got convinced. The numbers were not coming, but I added to my third tranche. The last line is very, very important. Have meaningful allocation once you're done, which means what? If you, I have a very concentrated portfolio. Okay, I have, anything between, at max, I will have 20 stocks, 20 companies, at max. So anything between 15 to 20 is ideal number for me. Sometimes I may have 13, 14, sometimes I may have 21, 22. As we speak, I have only 16. Okay, so 15, 20 to me is the right allocation. Some people say you should have 25, 30. Some people say you have 20, 30. Whatever works for you, you work with that number. Only thing, have meaningful allocation. Imagine if you have invested 0.5% and that becomes 10%, it only becomes 5% of your portfolio. It goes 10 times, it will only become 5% of your portfolio maybe. So have meaningful allocation, but meaningful allocation after you have done all your homework. Okay, after meeting the promoters in the AGM or otherwise. Okay, if you're not getting meeting of the promoters, because normally you will not get meeting of the promoter, so ensure that you are in the AGM. Okay, ideally physically. Okay, nowadays many people don't do it physically, online still it is okay, you can ask all the dirty questions. Okay, in fact, I asked Rajiv Jain, the CEO of Bajaj Finance. I'm invested in Bajaj Finance. So I asked him 2 dirty questions. Okay, and credit goes to him. He took it very positively and answered me back. And I asked him, they don't have customer orientation or customer centricity, customer focus in their value document. which means what? If you don't have as a value, are you not focusing on the customer? Maybe that is the reason, many of you would be getting too many calls from Bajaj Finance. So I asked him this dirty question and he answered beautifully well. So what I'm trying to say is that even if you're not able to attend the AGM in person, attend online, ask those dirty questions, which will give you conviction about the promoter and the management. Have at least 3 investors who can question your hypothesis. I've been lucky. Actually, I have more than 3. And, sometimes it becomes a problem, because I have more to cut the noise than to have my hypothesis tested. But I've been extremely lucky. I have some very good investor friends in Dubai. We have a small investor group here, okay, where, you can test your hypothesis. So people will talk in favor, people will talk against. That helps you. So if they talk in favor, you may get additional points to ponder upon. If they question the hypothesis, you need to be more prepared, study and come back and check with them again. The noise, ability to analyze quickly, simplify things. In today's world, you have to convert information to insights and simplify things for yourself. Okay, you need not be in everything. Okay, you need not understand everything. Leave those. This is very important. We are into a profession, whether you're doing part-time or full-time, we are into a profession where behavior matters more than skills. What I mean is that you think, you go to, a doctor, God forbid, someone is having a heart surgery. You don't look at the attitude of the doctor, right? You look at the skill of the doctor. You don't say, he's egoistic. He's not, he's not treating me well. Okay, he's not humble. He's not human. Let all those God take care, and he should be, good with his surgery, the skill, right? But we are in a profession where your behavior matters. When the share price drops from 1100 to 300, there will be 2 type of people, where one type of behavior is panicky and selling it at the low. The other behavior is saying that, discount sell is on. So if discount sell is on, when you go to a market, when discount is on, you buy more, or you sell when the discount is on. You buy more. And in discounts, this is the only profession where when the discount is on, people actually don't buy. If you see a brick and mortar store, okay, where a discount is on, you want to buy something costly, whether phone, or whether, your sunglass, or whether you want to buy shoes, or whether you want to buy, shirt, trousers. If you see 50% discount, you go and buy, right? This is the only profession where the discount is on, say like COVID, you don't buy. On top of it, you sell. You don't do that. Because see, investment is simple but not easy. What is investment? You have to buy a good company, right? You have to make good money. You have to get longevity in that business. So how you get longevity on this business? You need to be in a sector which has longevity. You need to be a company which has longevity. Okay. Now, how you quantify longevity? You quantify longevity by doing a DCF calculation, putting a terminal value. Okay, but that is statistics. Okay, statistics of putting a terminal value. So, for example, today, if you see, you move 50% of the valuation comes actually from terminal value. If you actually do any analysis. Now, when 50% of the value is coming from terminal value, which means what? You are actually discounting the business at the end of 10 years with a certain percentage of growth for perpetuity. The business, the sector which you are invested in, the company which you are invested in, will it last that long? Forget perpetuity. Will it last 20 years? You have to answer that question. If the answer to that question is yes, okay, then half of your problem is solved. So when you imagine your return is defined at what price you're buying. So if you are getting a 50% discount, okay, during at times for that particular sector or company, you are buying it free. You're buying it free means if 50% is terminal value and 50% is earning growth for 10 years, and if the market or that stock is down 50%, you're buying that business completely free, only on terminal value. Which means what? Every time Bajaj Finance drop by 30, 40, 50%, and or Titan drops 30, 40, 50%, you just buy that business because you have got it free. Your only assumption is the business will last for 20, 30 years. That is the only assumption. So write for every investment, write a note to yourself, okay, because this is very, very important. I don't invest in any company without writing a note to myself, and I constantly, I constantly evaluate terminal value as a part of my process. Okay, don't copy anyone. The last line is very important and the most difficult thing to do. Decide when to sell. Have your own framework, which is most difficult thing to do. Buying decision is far, far easier. You just need 4-5 multibaggers in your lifetime to make a difference. Hence, inactivity pays than investing. So Rakesh Jhunjhunwala, I keep on saying he's Warren Buffett of India, right? He's worth, when he passed away, unfortunately, he was worth I think 40,000 crores. There are only, his biggest wealth got created only in 5 stocks. So in a lifetime, to make a difference, I'm not saying your net worth is only in this 5. I'm saying to make a difference, you just need 4-5 multibaggers. I read one article maybe 9-10 years back where the person had actually done a evaluation on X and Y axis between the type of investors and the percentage return they had created with the percentage accuracy, okay, on the decisions they have made. Okay, so everyone fell between 58 to 66% of the time they were right, including Warren Buffett. Warren Buffett is right little over 50% of the time. But when he is right, he is able to write those for a very, very long time. He always gives his best example of a company is Seas Candy. Okay, so you look at his holding for how many years. So you have to just see when you're right, how long you're able to write them. Okay, how much return you're able to make on them. So like I said, it's not number of times you get to be right, but when you're right, how long you write your winners. This is the graph which I presented. These are the sources, as I said, when I started my career, I was into part-time investment before. Okay. I never had, it was very difficult to get an annual report unless you are a shareholder. So, what we used to do, we used to buy one share and the annual report used to get couriered to our house. Okay. And then you had to read that annual report. So there was a big time lag between, what you want to know and when you came to know. Okay. But today it is so easy. I started, as I said, 1999. That time, internet was just penetrating. Okay, Google was just coming into. There was no WhatsApp, there was no Telegram, there was no Facebook, there was no Twitter. Okay, so there was no screener. Okay, value picker was not there. Okay, SOIC was not there. Tijori Finance, Market Mojo, Money Control, Investing.com, nothing was there. Okay. Research Bytes, another good web things which I go through. Okay, so these are the few things which I which I go through every day. Okay, I normally use screener 99% of the time. 1% of the time I use Tijori Finance. I love one of the features which they have, which is reverse DCF. So I was keeping on telling, how you find longevity and terminal value. Okay, so I find that feature of Tijori Finance, which as per my knowledge, no one gives it. It's very nice. Okay, for example, I was just talking about Unwan Finance. Is Unwan Finance overvalued? I would say yes. Today it is overvalued. Okay, is it overvalued for 5 years? The answer to me, don't take it as an investment advice, please. Uh, is it overvalued for next 5 years? I think no. Is it overvalued for next 10 years? I think the answer is no. Okay, the reason is, again, I'm not giving it as an investment advice. Please don't, go and buy it because my purchase price is way lower. Okay, so why I'm saying this with respect to reverse DCF is if you see Arman is valued at I forgot the track, maybe more than 4 times the price to book, or maybe 4.5 times price to book. I don't know the number on price earning. I don't know the number, but what I'm doing is it is definitely overvalued today. But if I do a reverse DCF where I see after 10 years whether the business will survive for 10 years or not, I see the answer to this is yes. In 10 years time, whatever is the profit, if I give a multiple of 15, only 1.5. So what is the profit growth the market is assigning to this? Okay, if I do that in Tijori Finance, the answer is only little over 5% profit growth for the next 10 years. Okay, so is it overvalued given that growing at 35-40%? The answer is no. Okay, similarly I do for Bajaj Finance, I do for HDFC Bank. Okay, so I personally feel, if you have to look for first of all, don't look for multi-baggers, look for good businesses which has a huge tailwind. Okay, so tailwind could be a lending business. Okay, because if India GDP is going to grow, nominal GDP is going to grow at 12-13%. Okay, the multiplier to the GDP is normally 1.5 times when it comes to lending. So 1.5 times of 12-13% comes to 17-18%. So I feel when corporate debt to GDP, okay, is for India at its lowest, and when you have nominal GDP growing at 12-13%, lending will grow at 17-18%. If lending grows at 17-18%, if you choose strong players who will become stronger, like Bajaj Finance or HDFC Bank, Arman is very small, so I'm not putting it strong. Okay, I'm just saying if you want to play MFI, so say in MFI they may be strong. So if you look at the sector tailwind and find businesses which can last for 10 years at least, okay, where you can see for 10 years, use the reverse DCF in Tijori Finance and see how much the market is valuing PAT growth. If you see market is valuing PAT growth for 10 years significantly lower than the valuation currently, you may think of investing in those sectors and companies. Okay, now what is the disadvantage of that? The disadvantage, for example, I did a reverse DCF on Bajaj Finance also, and I found it, it's beautiful. Okay, I can still invest in Bajaj Finance. So I decide, and tomorrow I invest in Bajaj Finance. Can the market correct in 1 month time or 1 week time? And can Bajaj Finance drop down by 20%? Yes, it can. Can Arman drop? Yes, it can. Okay, can HDFC drop? Yes, it can. So I will have the pain, when that 20% drop comes in until such time that 20% recovers. And it may take, quarters or years to recover. But in 10 years time, will it recover from the present price and I will get a good CAGR return on my share price which will be more than the profit, and the profit will be more than what the market is factoring? The answer is yes. So it's a toggle between your short-term expectation of the market, how much pain you can suffer, vis-a-vis long-term, how much return you want to generate. Okay. So basis that, during this bull market, you should actually, I'm very actually surprised on this euphoric bull market, and I'm scared also because my portfolio is doing well, my companies are doing well. Okay, so in this market, I'm trimming some of my positions and also getting the dud out of my positions. When I'm saying dud, I'm not saying they are very bad companies, but I have some companies in solar which has gone up very high. Okay, so let me get to a better company and better opportunity in that space itself is the one way of looking at it. So use this euphoria to get to a better quality portfolio. If you're a large cap, mid cap, or a small cap, doesn't matter. Okay, so that's it. One of my favorite writer is Morgan Housel. Okay, I love his writings. He the way he articulates, I don't think anyone can articulate that well. Okay, and my presentation sums up by two of his good quote. Okay, the fastest way to get rich is to go slow. Focus on T, not on R. So instead of focusing 35% R and T of 1 year, focus on R of maybe 15%, 20%, but T of 10 years. You'll make more money. Most financial debates are people with different time horizon talking over each other. So what it means is say I'm repeatedly taking example of Bajaj Finance. The way I'm taking the example of Bajaj Finance because people think it's overvalued, price to book, I don't know how much it is. I'm not recommending Bajaj Finance y'all to invest, but I'm saying this company is different. The CEO Rajiv Jain is out of the world. I think after Deepak Parekh, he's the best CEO India have ever produced. So from that perspective, okay, if I talk about Bajaj Finance, people will say it's overvalued. Okay, so the people who are saying it is overvalued may be saying from a 1 year perspective. But when I'm saying from a 10-year perspective. So this sums it up. Most financial debates are people with different time horizon talking over each other. Okay, one is talking with 1 year, one is talking with 10 years. Thank you very much. I'm sorry, everyone. I have taken more than 1.5 years. It's now more than 1.5 hours. It is 2 hours now. Thanks for listening to me. And Ishmoit, very sorry I've overstretched. Thanks for giving me the opportunity.
I think I'll just open the comments and actually I have a lot of questions as well. So just hopefully let's thank each and every one of us too, sir. And because I think he was very kind in sharing his entire experience of wealth creation, and he's someone who's actually a practitioner and just not into theoretical gyan. So coming from practitioners, it may carries much more weight. And I think like for last 2 hours, I was just totally engrossed into the presentation.
Thank you, Ishmoit, for giving this opportunity, and thank you, everyone.
So, sir, had a couple of questions, and firstly, thank you so much for the insightful presentation. So, Devanshi, the first question was on these qualitative insights. Like you gave the example of Arman. So we have also seen their office in Gujarat, and it's like totally affordable office that it's purely focused on collections, and it just reflects in the office infrastructure. And, in some of their con calls as well. So for a retail investor who doesn't go to AGMs or who's just reading the con calls and the annual reports, is it possible to get these qualitative insights? Because if we are benchmarking the industry, then only two players, that is Credit Access Grameen and Arman, only these two players totally stopped the disbursements when COVID came, whereas others were still doing those top-up investments.
Yes, very good question, Ishmoit. Okay, I personally feel now when one is in for example, in MFI space, okay, the MFI space is actually three type of players. One is who are dedicated MFI. Second is small finance banks, and third is banks who are doing it indirectly. So in dedicated MFI, there are two good players. Okay, one is, according to me, I may be wrong in future. One is Credit Access Grameen, and the second is Arman. Okay, now if a retail investor is not able to go, okay, then the choice the retail investor have is whatever is available on internet and the con call and the research report by different houses. So from that perspective, then it is better for for that particular retail investors to stick to Credit Access Grameen, because there are a lot of research report on Credit Access Grameen and there are hardly any on Arman. Now, if someone wants to take a little bit of risk and a little bit of effort and say that I want to go to the AGM of both, okay, and then goes to the AGM of both and decides between the two, okay, maybe Credit Access is better, invest in Credit Access, or thinks that Arman being smaller will do better, invest in Arman, or maybe if confused, put some kind of allocation in both. So to answer I give a long answer to a short question. I would advise, if you're not able to go, then stick with the number one player. Here in the case is Credit Access Grameen.
Right, sir. Right. And second is like on this qualitative insight, like you gave us for RACL Geartech. I think RACL Geartech opened up in their quarter 4 FY20 was their first ever con call. Right, sir? So post that they also did an investor day in which they gave a lot of information to us. But this quality of customers in a B2B business, like we've also seen this with the example of Usha Martin. Like when they divested their steel business and we saw some of their customers, it was world's top 2 players in steel wires and ropes. So how much emphasis do you lay on these qualitative insights? Because some of the managements who AGMs में तो online 30 minutes में भाग जाते हैं. So this just how the business is talking. Like,
yeah, you're right. In some of the AGMs, people do 20-minute, only 20 minutes for procedural purpose. But in that 20-minute also, you will be able to catch one or two questions, right? And on the sidelines, you may get to ask the promoter. So always it helps in going to the AGM. And I'm sure the way you also do, Ishmoit, the way you are so active in this space, and in spite of your so busy schedule, the way you go to AGMs and attend. For example, take the example of, we are talking about RACL, the quality of the clients, right? I'm just extending that to B2B space, another player called Shivalik Bimetal, right? Now you see, off late research reports are coming, but before that there were no research reports. Now, if you go to AGM of Shivalik Bimetal and see they're serving to the best of the players, tucked away in remote corner where it is so difficult to go for the AGM. So something the company is doing right, where they are able to service to the biggest of the biggies. Okay. So it says about something, right? So in spite of they not giving time for the AGM, they're doing something right. And if you're able to get even 5 minutes of qualitative AGM, or 5 minutes of the time of the promoter, it will give you a sense. It's like, when you meet your wife, or when you met your wife, you're not married, I'm assuming, or you met your girlfriend, if you have time. Okay.
Basically, I do have a girlfriend for like last 11 years.
Oh, fantastic. So what I'm saying is that, you may like someone, but you cannot say why you like that person, right? So something clicks. So that is the connect which you build, with a person. There's no one answer to this, but you will suddenly realize, it's worth coming, and it's worth that I have some insights which is unique and which is different and which gives me more conviction than had I not come in. So I put a lot of emphasis on visiting AGM. If someone wants to take an extra effort, if someone is in a job, I was not able to do this before, let me tell you frankly, and so I was sticking more to the known players. Okay. But once one of the reason was to get into full time so that I can do this. Okay. So for example, I'm based in Dubai, but every month I go to India. some meeting or the other, I will go. July, August is very busy month because of all the AGMs. So you actually not only meet the company, the promoters, you meet like-minded, people, investors. So July, August, suddenly I see my compounding, not on wealth, but my compounding on knowledge through fellow investors or the relationship on the network I make. Okay, by knowing people, certainly in 2 months, my knowledge significantly increases.
Right. That is true. I think especially the month of August is full of these AGMs and you keep traveling. August and September, maybe I think Shivalik ka September mein hi hota hai.
Correct.
Right. That is true. I think because once the AGM is done, you also discuss what was your view, initial discussions. So linked to this only, Deveshi sir, how important is to have these sounding boards? Because a lot of retail investors are watching this, and we keep conducting these offline meets so they can at least एक दूसरे के साथ भी network कर ले, so that you can create these sounding boards for yourself. So how important is these sounding boards? Because sometimes they help you a lot, because if two people are researching on the same company, so a lot of unique perspectives end up coming in.
Absolutely. So for example, I personally feel, these sounding boards is very important, but it is also important to cut the noise. Sometimes what happens, you make two types of errors, right? Error of omission and commission, right? Okay. So, you will make an error where you want to, if you have a diversified portfolio, you want to be in many companies, right? But in doing that, you will make errors also. Okay. So then there are second type of thing which happens where you want to, not make those errors and be in companies which have good, qualities. So it may have come to you a little late, but you still want to be invested in this. So you having a good network of people who can, who you can talk to is very important. At the same time, how you cut the noise is also very important. So what I do, Ishmoit, in my, I don't have a presentation, so I break companies into phases and sectors into phases. So for example, if I have, if I put sector which are evolving or sectors which are saturated or matured, okay, or something in between, there are three types of sectors. Let's assume, for this example, we have three sectors. One is FMCG sector, which from a penetration point of view, when I'm saying penetration, I'm saying, say Marico is into oil, or Unilever is into, say soaps. Just I'm simplifying it, just to make my point. The sector is penetrated. Okay, so you cannot have, when per capita income moves from $2,500 per capita to 5,000. It's not that people will consume more of oil and more of soap. They are going to consume the same, because the penetration in this household is more than 90%, right? Then you have something which is into say lending, which is penetrated but not penetrated to the extent what it should be. Okay, and the second is a new theme, say renewables, so which is the evolving thing. So if you find the sector and do a growth of the sector, FMCG will not grow beyond 10%, right? Volume. You have lending, which will grow at 1.5 times nominal GDP, which is 17-18%. And then you have renewables, which will grow at 20% per annum. Now you have mapped the sector. Now you choose the companies.
Okay. So it's a sunrise industry versus a industry which is fully penetrated.
Correct. And then you choose the companies. Now you want to play, you don't know who will be the market leader in renewables. If you leave out, Adani and Reliance of the world, there are so many players. You don't know. You can have a basket approach. Okay. Similarly, lending, who are the top 1, 2, 3. For example, I keep repeating, Bajaj Finance example, not to give an investment advice, but I'm just making my point. Bajaj Finance is just only 1.5% of the market. Now, they want to be 4 to 5% of the market. And the market is growing at 15, 17%. Now, if you compound 15, 17% market growth and take a 10-year growth, And if Bajaj Finance wants to become 1.5 to 5%, technically you are able to gauge what will be Bajaj Finance growth. So technically Bajaj Finance will grow by more than 25, 26% by this matrix itself for the next 10 years, right? So then what you have to evaluate? You have to just evaluate its terminal value, okay, and the valuation. So go to Tijuri Finance, do a reverse DCF and see whether, you are comfortable with, the terminal value.
Right. I think a very important aspect to think about the TAM and reverse calculate the number to justify the valuation today.
Yeah.
Right. Another very interesting one is that actually I created a lot of questions. Is that so just this question of terminal value expansion. So we've seen that Bajaj Finance went from, so just a hypothetical example, went from auto loans to personal loans to housing loans to n number of loans, and a microfinance, gold loans, everything they want to do. So companies which are actually suffering in the near term because they are de-risking themselves from a risky or volatile segment. Let's say tomorrow Arman starts business loans, which they've already indicated, and business loans over a period of time becomes 50-60% of the entire mix. Like Tata Lexi's case, 2019, 2020, mein Jaguar Land Rover was used to be 26%, right? And the moment that mixture went down, so there was a terminal value expansion element because new customers got added. And now because there is no large concentration risk, so because your customer base is fragmented, so eventually your valuations will start reflecting into a higher multiple. This is also happening in one of the small finance banks, which went from 40-50% microfinance to only 18% today. But पूरे time में उसका ROA और ROE खत्म हो गया इस वजह से, but now it is recovering. So how do you think about this mental model, Debeshi sir, that terminal value is good, but expansion of terminal value gives the real re-rating going from 10 to 50 to 60p, and it has happened in a lot of businesses.
Very good question. Ishmael, what I do is that, I look at this in periodic intervals. I don't do every quarter. So what I do, for example, this cycle, okay, is actually, I have a good problem in hand, but it is a scary problem where, most of my, companies is in all-time high. It gives us very scary feeling, right? And at the same time, I don't want to sell them, right? So, what I have done in the last, 1 week, 10 days, or maybe in the next 1 month, I'll as I said, I have, core portfolio and a seed portfolio, right? And something in between, right? So those kind of positions, I will, maybe trim down a bit and be it in cash, because, to answer your question, there's no straightforward answer, because no one can, judge, what will be the expansion on terminal value, right? No one can judge. I'll just give you an example. For example, Tata Elxsi we spoke about. I never thought that a company like Tata Elxsi will move from 700 to 10,000 in a span of less than 3 years, right? Okay, I didn't want to sell the stocks, but you are also human, right? You once in a while you will see what is the PE, right? So I think shot to more than 100p. So that scared me. Okay, so so which means what the market is valuing what you're saying, a huge terminal value, right? Okay, whether they can get or not, we don't know. Okay, but what to do in such scenario? I don't want to exit that position. Okay, so I have sold. I've trimmed down the position. Okay, and allocated it to a different company.
Right. Actually, I was just recently reading this book. I think I think what I learned about investing from Darwin by
Prasad. Yeah, this is a very good book.
Right. Almost about to finish it. I think for 1 week may, because it is so well written.
Yeah.
I think they talk about in the book, we focus on buying, right, and then we never sell if the promoter continues. Right.
Same like Warren Buffett, right?
Right. So I think very well put, sir. I think a lot of these. So another example, because we were speaking only, so this example came to mind only. We studied this a company which is into basically manufacturing beverages, एंड बेवरेजेस ऐसा कोला का तो पेनिट्रेशन हो ही चुका है इंडिया में, मतलब 9-10% से ज्यादा क्या ग्रोथ आएगा. बट दे ऑल ऑफ अ सडन इंट्रोड्यूस दीज वैल्यू एनर्जी ड्रिंक्स. स्टिंग करके एक एनर्जी ड्रिंक आती है, विच I saw recently even auto walas have like 10-15 ऑटो लगे तो सारे स्टिंग पी रहे थे एक दूसरे साथ मिलके. And that, like you mentioned in FMCG, that category from scratch has, so that company now has done a business of almost on run rate of 2,000 crores in last 2-3 years, from 0 to 2,000 crores. So how important is to identify these incremental changes that happen with introduction of new products? Jैसे Royal Enfield में they introduced a classic bike, and that their sale went from 60,000 bikes per annum to almost 7,70,000 bikes, like within a span of 9 years. And one had a lot of time to assess it. I think 3 years बाद भी ले तो भी पैसा बन जाता. So what's this idea of getting this rate of change or getting the assessment of change correct in investing?
So, again, a very good question. I'll give you a FMCG example, because that will be easier to understand, because other example would be really tough. Okay. For example, when I talk about penetration of oil or penetration of soap, right? So the penetration may be more than 90%, some cases close to 99%. But you're talking about penetration of a category. Now in oil also, there's an unorganized and an organized. Okay. At a household level, when AC Nielsen or any other research agency would give penetration, they are giving penetration of the oil as a category. Now in oil, suppose, I'm just giving example, suppose oil, there's a branded and an unbranded. Branded and unbranded put together, the penetration is 99. Maybe the branded penetration is 90. So you have still 10% growth. And then you're talking of oil, which is not a value-added product. Now, suppose Marico, or for that matter, Dabur, wants to get into a value-added product. Okay. So when the suppose coconut oil is a normal oil, right? You don't have any value addition to it. Suppose you add something to it, it becomes a value-added oil. Value-added oil penetration will not be 90 or 100. It will be much lower. So the headroom for growth comes from that value added. So coming to your thing, the cola, when you talk of cola, whether Coca-Cola or Pepsi, that penetration may be 100. But when it comes to energy drink, say, a Red Bull, the penetration of Red Bull, which is a different category, okay, which is an energy drink, the penetration may not be 100. So in that, how you assess is if a company, for example, Coca-Cola, has certain positioning in the market, or for that matter, the company which you are talking about, I don't know about that company, it will have some Arun Beverage. I don't follow it. So I'm saying you have to see what is the core proposition, and when they're extending, it should not dilute that core proposition. So the brand should stand for the proposition, and the extension to adjacency should not be far away. Once it is far away, then it actually not only it hurts the main brand and the main core, and it can be detrimental for get growth. So that doing it is very important, and some companies do it very well. For example, P&G does it very well. Unilever does it well. Okay, so we need to be very careful, when companies are extending, whether that extension is outside the core or adjacency to the core. Because if it is adjacency to the core, the chances of success is far higher. When it is outside the core, the chances are very less.
Right. That's interesting. And so link to this, because we first so you've been investing since 1998, right? And
Yeah.
a lot of leverage at that time to invest. So actually, like, मैं तो broker पीछे पड़ा है कि sir, you should start a leverage facility. You should invest. So that was like a bit of a tell sign for me that you shouldn't do it right now, right? Yeah. So some of them have done really well. Some of my friends have done really well by taking leverage to invest in bear markets, actually. But bull markets may, like, they've like done well apart from that. So what do you think is the importance of seeing these multiple cycles? Because we've seen that every cycle will have a different winner or different theme that comes up. As a 2003 to 7 May, the real estate theme came up. Then between like 13 to 16, 17, a lot of NBFCs and banks did well. Then post 18, a lot of chemicals, like the chemical rallies was ferocious. A lot of them became 20, 30 baggers. Now we are seeing the likes of like small finance banks, microfinance, railway stocks, renewable energy. All these things are doing well. So, like in my limited observation, I've seen that these sectoral moves also happen together because you're a grander part of a theme. And these like every new cycle has a new basically winner. So how do you think about this entire construct or structure of the basically market? Because old winners, like let's say 2016, 18, mein, a lot of large private banks like HDFC, Kotak, and all these guys were like huge winners. Apart from like Yes Bank and DHFL going bust. But now, like we've seen the last 3, 4 years, these businesses have been stagnant. Tier 2, tier 3 financials have done really well.
So, it's very difficult to, predict. Okay, you only know what got you here will not get you there. Okay, so you only know what has performed well will not perform well. Okay, and if you, it's very difficult to predict. So, I would rather not get into approach that way. I will approach where I understand the business. It is pretty simple, not so complicated. Okay, for example, infra spending, right, is a theme now. It will do well. Okay, but I don't understand, or cyclical, it will do well, but I don't understand, and so I'm out of it. So uh, I don't know many things. I keep learning. So where I'm comfortable, I will play that. For example, renewables I'm invested in. I've read a lot, but I still don't know many things. Okay, so I'm constantly learning. So when my conviction increases, maybe I will participate in some of the companies. Okay, for example, I don't understand Reliance business. Okay, so I never invested in Reliance. Okay, right, but part of the Reliance business I understand. So maybe those part I try to build my convictions. It's very difficult to be sector right always and also be company right in that sector always. So I keep it very simple, Ishmoed. I would rather pick up a trend which will work well for me, and pick the leaders and some niches in that. So, for example, I feel whatever has been done, lending space will do well. Okay, now private banks will do well, but it is a everyone is talking about private banks. So when or everyone talks about private bank, you will not make money. So you should do something which others are not talking. So people are not talking about HDFC Bank and Bajaj Finance now. So I have started investing in HDFC Bank, which I never invested before. And Bajaj Finance, I was invested. I'm just topping it up. Okay, can I be wrong? Yes, I can be 100% wrong. Okay, I'm just saying that I may not make a huge return, but I will make a decent compounding. And I'm happy on some of the portfolio making 12 to 15% per annum for 10 years, which itself is a big number if you see for a longer period of time.
Right.
And that way the quality of the portfolio also improves, instead of being only in microcaps, right, in a bull market.
Right. Because in a bull market, you basically the risk curve of the portfolio, it goes down basically if you don't pay too much focus on the quality of ideas you're getting.
Absolutely.
Right. So, sir, one more question from my side before I take a couple of questions from the audience. So, one of the questions is this: in a way, it's like a core and a satellite approach, right?
Yes.
Right? You have a core portfolio of maybe 6 to 8% allocation in one, or 8 to 12% allocation in one, and you have a satellite approach where you're planting the new seeds, where you're doing these experimentations, like
Yes.
you're parking 1 or 2%, and you're seeing how your thesis plays out.
Absolutely.
This portfolio construct. So, just a question. So, has it been like a lot of times the satellite ideas they move into core as the businesses and the managements perform?
Yeah. Not lot of the time, most of the time. Okay. For example, all these four companies which I talked about, okay, was part of, satellite, before 20 or around 2020. It moved to core, when my conviction it's not about the share price. Okay.
Right.
It's not about, I move it when I say core. My core is not large cap, mid cap, small cap. My core is where I have conviction, irrespective of the share, performing or not.
Right.
Okay. So, for example, HDFC Bank, I told I just invested. It is part of my satellite portfolio because I still don't have enough understanding of HDFC Bank, is what I'm saying.
Right. And there are these inflection points which even come in your satellite portfolios, and you think, yeah, it's something. Maybe your understanding also improves, and then it moves to the core position.
Exactly. Okay. For example, I said I invested in Dinoda. Okay. I
Right.
have tried all methods of trying to, meet someone who
Right.
has a better understanding of Dinoda. So whatever is available on net, I have done it. I have made a document to myself which run in 7-8 pages, but there is nothing which is getting added to it, because nothing is there. I have tried all means to meet the management. Now I'm just waiting when the AGM will get announced and I can fly down to Goa and ask them questions which I have in mind. Okay, so that I can invest my second tranche. Okay, now Dinora, the stock has performed, but still it is in my satellite. Okay, because the stock has performed, the company has also performed. They have got a big Reliance order. Reliance, when I invested in Dinor, it was a 400 crore market cap. Last end of last year. Okay. Now imagine a 400 crore market cap getting orders from Reliance. Okay, a big order, and then the Italian parent company, which has 253 patents. Okay, and they have tied up with the biggest of renewable companies, both in private equity space, and this company is also listed, by the way, in the Italian multinational company. They, in their con call, talking about Reliance order. So which means there is something which is there, I don't know, but still it has not moved to the core, in spite of me not. We will not sell this until unless I figure it out what is happening. Okay, it's still in the satellite seed portfolio. Once I am able to meet them in AGM, and if I'm convinced, then I will move to core. If I'm not convinced, I will sell it.
I think similarly, there's this another MNC, DISA India, karke, and that is also there. Which I've been tracking. LinkedIn, pe they're announcing huge expansions, but there's no information to research on. And then you like, okay, leave it alone, because the company abroad is talking about the Indian growth opportunity, but there is no con call or information bottoms up from the India for the Indian company which is listed.
Yeah, good. You pointed out LinkedIn. In fact, I have sent LinkedIn. Invites to all the people in Dinora, India and Italy, whoever is on LinkedIn. So they have accepted the LinkedIn, request, but refusing me. In fact, they're not refusing; they're ignoring the meeting request.
Right. Quite interesting. Actually, LinkedIn is a very powerful source. Like some of the, like you can see the quality of hiring the companies doing, the quality of.
Correct. Since we are on this topic, Ishmit, I forgot one thing to tell. I also see Google reviews.
Right.
Okay, because Google reviews, speaks about the culture, about the brand, about the company. Okay. So recently, I invested in one company where I went to the Google review and saw reviews of people who didn't join, what they're talking about the company. And I see a good, review of those people talking who have not joined. So that speaks about the company.
Right.
So these small things now makes a big difference to your investment thesis. So, for example, if you get a IT company which structurally has a lot of attrition rates, okay, and if you see a company which has a low attrition rates and people who are not joining talking good about them, which means that company is good culturally, then you have to see their clients and see how capable they are in terms of execution. So if your raw material is the people and people are talking good and you have good clients, okay, and it is available at reasonable valuation, then you have a winner.
Right, right. That is true. That is true. I think वो softer aspect का you get a feel because that's a people's business.
Correct.
Right, right. Similarly, in lending businesses, you get a feel of the MD that what is he talking? What is he focusing on?
Absolutely.
Commissions? Or is he just
Absolutely.
talking about disbursement?
Absolutely. For example, what I find, in Arman's case, actually the employees talk about disbursement and the promoters talk about collections. Okay.
And actually, like talking to the promoter, you become pessimistic because he says things like, "Ki, tomorrow my business is going to close. I don't know." You're like, "Ye kya hua?"
Absolutely, and that I like. I told Alok that when people see you, no one will invest. Okay, because they get a very very pessimistic view about the promoter. Okay, so he's again a when if you have to understand MFI, he's a good person to understand the category, the sector itself. Okay, and plus this person I'm talking about, Alok, he's very rational and conservative. Okay, and he's a person who under promises and over delivers. So you need such type of promoters who under promises and over delivers. In,
I
in
actually I didn't read their con calls. I heard them live because I think listening in such companies gives you a better insight about the promoters, like the tone he's talking.
absolutely right.
Right.
You see, Rajiv Jain, when he talks about growth, he always talks about growth in the range of 24 to 26% and keeps on delivering much more than that.
Right. That is true. I think so there's this hospital, Narayana Udyalaya, they will always keep saying कि यार 6-7% growth भी आ गई तो बढ़िया है, भगवान का दिया सब कुछ है, we just need 6-7-8% growth, and then they deliver 50-60% growth for last 2 years in a row. And then like you're shocked because then you get to know their character ki they will always underplay because they're in a socially sensitive sector, but they will always give higher PAT and cash flow growth and stuff.
Absolutely.
Right. So thank you so much, Debashi sir. I'll just open the chat section for a couple of good questions because if I start asking more and more questions, so I think 4-5 p.m. tak to it will carry on. Right. So just opening the chat for any questions. And so Ketan has a question. So I think he has a question. How do you find new ideas? Any website or like any other things that you use? So just a question on stock filtration, and he's just asking do you take any cash calls in your portfolio, and what's your thought process of doing so?
Yeah, I actually get a lot of ideas, from meeting people. So as I said, though I'm based in Dubai, but I go to India every month for some reason or the other. Okay, so I will meet investors. Okay, for example, in March, I think there was a Value Quest conference which I attended. There were more than 100 investors. Okay, so what happens is that then the problem is not what you call ideas. The problem then is how you cut the noise in those ideas, right? So for me, I feel it's not the ideas which comes in. It is how you quickly eliminate the ideas, okay, and then get to a few ideas which you can study. Sometimes it takes anything between 1 month to 3 months for me to study that sector or that company. Okay, and suddenly you realize bull market, the company has already gone up.
Right.
Okay, so at any point of time I will have a watch list of 15-20 companies. At any point of time I always keep a watch list of 15-20 companies. Okay, and as and when I am convinced that this is not worth investing, I remove from the watch list. And when I'm convinced that it is worth investing, but the valuation is not right, I also always do a valuation on Excel through Screener. They have a great feature. When we once do the valuation, you can replicate the valuation every time for your every company. So I do that valuation, and when I'm convinced it is good but not rightly valued, I'll keep it in the watch list. So like that, I have currently maybe 15-20 companies which are good but not right valuation. and I'll keep, knowing more about them. I will keep alerts so that, I know what is happening.
So actually, this was a question. मतलब इसके साथ ही आया कि so we are in a market environment where so for multi-baggers to come, the PE needs to re-rate. But in a lot of businesses these days, कि starting valuations might not be that favorable. मतलब हो सकता है काफी में हो भी, but in a lot of majority of the businesses not favorable. So in such scenarios, how do you think about taking cash calls? That is one question. And second is linked to the options one. What do you do in options? Do you sell to make up for opportunity cost, or what's the process over there? My knowledge about FNO is very close to zero. So
yeah. So coming to valuation, so I break companies into phases. Okay, and I toggle between sector and company phase of growth. What phase they are in? Okay, for example, if it's a phase one company, okay, so I will not look at valuation. I will look at market cap of the company in the overall scheme of things. So I may be buying little expensive, and anyway I buy in tranches, so I'm not going to buy at one go, right? Okay, but that doesn't mean I will buy a phase one company at 100 P. Okay, so the point I'm trying to make, if I get a market cap, I'll just give you a Denora example. Okay, so if I tell you I'm buying a small cap at 27 P, it is costly, right? But I'm looking in the context where I bought Denora at a 400 crore market cap in the renewable sector, which will become 500 billion US dollar in 2030, right? So I'm looking in the context, okay, whether this market cap is small in an ocean where the company has done well and the company can do well. Okay, then I don't look at P, but that doesn't mean I will buy Denora at 100 P.
Right.
And coming to your cash question, I have clearly segregated my portfolio. So if my portfolio, as I said, my stock portfolio has two elements, okay, core and seed. And then I have an option portfolio. In my option portfolio, it is around 8 to 10% of the total portfolio. And in that 8 to 10%, option portfolio is separate. Coming to cash call on the core and seed portfolio, earlier I used to keep any cash between 8 to 35%. I'm talking over last 5-7 years. That has been the cash. Anything between 8 to 35% has been the cash. This is the first time in the last so many years and 2 decades, I'm at only 3% cash. And I'm scared about it. Okay. And coming to your question on options, what I do is I have traded US options in 2013-14. US is very matured market. So the Indian option market is very immature and very illiquid. Okay, so when you have an immature market and an illiquid market, okay, you need to be very careful. Okay, so option works that when volatility is high, which means option volatility is high, premium will be high, so you sell options. And when premium volatility is low, premium is low, you buy options. In India, it doesn't work out that way. More than 95% of the time, people will lose money in FNO because most of the people are buying options. So people who make money are those who sell options. Okay, I sell options. And it's not that if you sell options, you will make money. In selling also, people normally do a straddle in Band Nifty, okay, to make returns. I don't do those kind of things. I sometimes do those kind of things, not always. Okay. I mainly like to trade in Nifty, okay, and selling options. Coming to using option as a hedge to the portfolio, people normally buy puts to hedge their portfolio if there's a drawdown in the portfolio. I don't do that because in India the cost of hedge is very high. That's why I don't do it. but sometimes I use FNO to be in a particular position. So, which means that if I'm very bullish on a particular stock from a short or mid-term perspective or a long-term perspective, okay, and in a stock is very liquid and it is a large cap, then I may take a position in future in that stock. In FNO position, I'm saying. But I will roll over that position. I will not trade for a day or few days in the stock in futures.
Right. So last two, last 2-3 questions. One of them is this. So any over a period of time, base rates of success. Okay, I think good stock because I have 60-65% of hit rates correct. I think it to ho nahi sakta. So any case study which you can share without even naming the company where you thought something will happen but something else happened, then you hit the then your exit framework got basically made because of it.
In fact, I will talk of 2 companies where I actually could not get an exit. Okay, so it's the worst example than what you're talking. Okay, so this is a company which was into which is into media. This company name is MRSS. It's into research company. So this company, it was run by someone who had a huge experience. He hired a CEO who was from AC Nielsen, then acquired a company in Singapore. So everything was going fine, but they had lot of government projects where receivable got stuck. And I am guessing, it's not fair to comment in public forum. I personally feel there may be corporate governance issue also. Okay. So now this stock was very illiquid. I couldn't get an exit. Okay. So I'm still holding on to the position. I've not written it off in my portfolio tracker because it's a big learning for me. That's why every time I see the loss, I tell to myself, that what is the learning from that? Okay, so that way, I have written off in my mind that amount, but I have not written off that company name. So I always see that red, and it reminds me of my learning. The other is a cyclical industry, okay, which it's very difficult to what I've realized is that I'm never going to again invest in cyclical industry because I don't understand cycles, okay, and I'm very poor at it. So let me not try it, okay. So that was the second. Again, that stock I could not exit.
Right. So any exit frameworks that you use even in your core holdings?
Exit framework, I do 2 type of exit. One is, where the P gets to such an extent that you say that, it is not going to make money for the next 2 to 3 years. So let me trim it, okay, but not exit because I am looking at, longevity of the business, which is far higher than what otherwise, investors think. So example I gave of Tata Elxsi. And second exit I do when I see that I don't have, cash in my portfolio, okay, where I have found a brilliant idea, okay, and where I need to invest, but I don't have cash. So I have to sell something either partially or fully, okay. So normally I don't like to do fully, okay. So I will trim it again to capitalize on the opportunity and give that due allocation to a particular company, because ultimately what matters is your allocation. If allocation is very small, even if it becomes 10 mega, it doesn't do justice, right? So these are the 2 situations where I sell. One is very high valuations where I trim, sometimes I exit, and second is where I see an opportunity in some other things which will make far more money. That time I will shift.
Right. So just last question, which I is also there in the comments, also which I'll ask: any new youngster or any new investor who's coming into this field, any word of advice that you will have for him? And are there any books or resources which you will definitely ask them to go through? Especially the idea of reading books. If there are any 4 or 5 books they should definitely read when it comes to the world of investing.
I look up to you, when you suggest books, those are brilliant. They should not go away from, for example, just now the Pulak Prasad's book. There are people who have recommended to me to read. In fact, in the last 2 months, I think 4 people have recommended to read that book. I'm very poor in, reading books. I'm very good in reading, sector reports, articles. I love to read, sector report articles. Only people, and I follow someone, I follow few people. Okay, so on when whatever they write, I read. For example, one is Morgan Housel, then Ravi Kant is another. I like to read sector reports, articles, research reports, anything which increases my understanding. And books I will read, but it takes long time for me, to finish. And for books, I look up to you. Okay, for example, Pulak Prasad, you are recommending. I got recommendation before also. This is now a book which is a must-read. Looks like. So, what I advise, people who wants to start now is actually, go to Value Picker. The reason why I'm saying to go to Value Picker, if someone is researching. Because it has helped me as an investor. Okay, in Value Picker, you have good quality, discussions. Most of the time, not always. So if someone is getting an idea, it is best to give a search, go to Value Picker, read everything about that company on Value Picker, including the links which are given. And once someone has done that, then go to valuation, doing a valuation. Whatever model is good, do it on screener and see it. Then go third step to Tijori Finance, see the reverse DCF and see what market is valuing at. If you see sector growth and your feeling of growth is higher than what market is, giving it, buy it first tranche. Then go to AGM, get convinced, buy second tranche, buy on the rise. You will definitely be better investor.
Right. I think thank you so much for the presentation and the insight, sir. And some of the tribe members are asking, are you there on Twitter or Value Picker or any other social media forum so they can follow you?
No, I'm not there anywhere. In fact, that is one of the reasons. I didn't want to, present because I've never presented. See, I said I'm into the third innings, right? I presented as a CFO in many places. I presented as CEO in many places. Right. I don't talk about investment or presentation. You have been requesting for some time. Sorry, I could not,
No worries, sir. No worries.
Okay, so I'm not present anywhere, because, by today there's a lot of noise, and I don't want to.
You're part of that basically noise. I think that's.
Yes, I don't want to be part of noise, Let others make noise and I cut the noise and get the gist of that from them as my learning.
Right. So with this, sir, thank you so much for agreeing to do this. And definitely in September, we will meet. If you come to Delhi as well for any investor meets or any company visit, does let us know. So we'll definitely be, we'll love to host you as well. And just in the comments, everyone is also thanking they found us.
Thank you so much. Thank you so much, Ishmoit, for giving this opportunity, and thank you to all the participants. I'm sorry I didn't go through the questions. Okay, maybe I'll go if I can see it now. I will go through it for my own learning. Thank you, everyone, for hearing me out. Thank you.
Thank you so much, sir. Have a great day. Thank you. Thank you, everyone. Have a great Sunday. Thank you so much.
Everyone. Thank you, everyone.